Welcome to my crash course on technical analysis. In this video, you will learn every single type of level that I use in the markets. Not only that, you will also learn how I put it all together into one mechanical system for doing technical analysis that prioritizes high time frame levels for use in intraday trading. You are going to learn everything. I'm not joking. I'm putting it all out there. Every single level that I use, the theoretical parts of it, how you find it on the chart, how you mark it, my understanding of it, the small details, everything. I'm putting it all out there. Literally everything. And all I ask of you is to like this video, share it around, and also join the Discord if you would like. Without further ado, let's get into the first section out of a very, very long video and a very highly anticipated video of my technical analysis crash course. Alrighty, today we're going to be talking about liquidity and liquidity sweeps, arguably the two most fundamental and potentially important concepts in the entire way that I trade. So having a very good understanding of these things is definitely critical if you want to trade how I do. So first and foremost, what is liquidity? So if you just look up a definition, this is what it's going to tell you. Liquidity refers to the efficiency or ease at which an asset can be converted into ready cash without affecting its market price. So basically, if you have some sort of market like this, what it's saying is how big of an order can you execute without it really moving the market that much at all. And in a very liquid market, somebody could make a order as big of a size as they want, and it's not really going to affect price. A very liquid market requires a huge amount of money to move the market. Now, in a very non-liquid market, you could imagine a very small amount of money could move the market in a very big way. So when you talk about just liquidity as a term, although this doesn't really mean much for the charts, although later on, understanding just the word liquidity and what it means will justify some of the things that we do. It doesn't really do anything on the charts. All liquidity is, if a asset is liquid, that means it's harder to move. It takes more amount of money to move. And if an asset is very non-liquid, it doesn't take a lot of money to move. I could give you an example. For example, if I put $1 million into the S&P 500, which is a very liquid market, I'm probably not going to move the market at all. Versus if I go put $1 million into, for example, a very low market cap cryptocurrency, it may actually move the market a lot. And that's the difference between a liquid asset like the S&P 500 and a very non-liquid asset like a meme coin, for example. And I'm just using meme coins as an example because those are just extremely non-liquid assets to prove a point here. So that's all liquidity means itself as a term. But what does that actually mean in the market? What does that show up as in the market? So when we talk about liquidity in the market, this is generally what we're talking about. So this dashed line right now is going to be the current market price. And the way that liquidity shows itself in the market is in the way that follows right now. It is in the form of limit orders and orders in general, okay? Any orders that are placed above the market price and below the market price. So one thing that you have to understand right now is if I want to buy the market, right? If let's say I want to buy $100 at the market price right now. In order for me to buy at the market price 100, okay? I want to buy 100. In order for that transaction to go through, somebody has to be willing to sell me $100 of that asset at that price, right? Somebody has to sell at that price. So if I buy at this price $100, and in reality, by the way, these numbers are way bigger. In very liquid markets, sometimes we're talking about hundreds of millions of dollars to move the market, billions of dollars to move the market. We're just using small numbers to keep the examples very understandable here. If I wanted to buy $100 here, you'll notice that there's no money at the current market price. So what price would do is it would have to seek liquidity for somebody that wants to sell it to me. And oftentimes that's in the form of limit orders. So the market might reach up right into here and sell me $100, right? And then price would be here, and I would be filled, and I would be filled at this price as well. And everybody would be happy, right? So I wanted to buy $100 worth of the asset, and they sold me $100 worth of the asset, and that's what moved price up to seek for liquidity. So understanding this would also go to say that the primary function of the market is to seek liquidity, right? So for somebody to enter an order, the market has to seek liquidity. Now, let's take another example. Let's imagine I'm a person that instead of $100, I want to buy $400 worth of this asset. Okay, and imagine in this case, we're thinking about a market with not a lot of money in it. I want to buy $400 worth of this asset. So I place my order here. And ideally, in my head, this is where I want to buy. This is where I want to get filled. Well, if I buy $400 worth of this asset, price is going to go through here, fill me $100 at this price, come up here, fill me $100 worth of this price, come up here, fill me $100 worth of this price. And then because there's a complete and total lack of liquidity between these two levels, price will immediately gap up into the next liquidity level, which is what moves price in very dramatic ways. And my average fill between everything will really be down here. So if you think about that just for a moment and pretend that these numbers were much bigger than they really are, if I'm a hedge fund, if I'm a very, very large individual trader even, I may be interested to buy a security or an asset, and I would like to be filled at a price that makes sense for me, right? I don't want to be averaged up all the way up into here. So if I could reliably know where a lot of liquidity is going to be resting, then I could use that to my advantage. So because this is a bad situation for a person who has a lot of money, right? A person who has a lot of money where they want to get involved, but if they get involved, their order is going to be filled way up here just because there's just not too much liquidity in the market, and they're not going to be able to get filled where they want to. However, what if I told you that there was ways to somewhat reliably, at least, by the way, I just lost my whole spot here, which is kind of annoying. There are ways to at least somewhat reliably tell where liquidity is going to be resting in the form of old swing highs and old swing lows in the form of stop loss orders. So what do I mean by this? Well, take this high in the market right here. It would be reasonable to believe that people who are shorting up in here, people who are shorting up in here, shorting here, even shorting here to some extent, may have stop loss orders above this high. And the reason why we could be comfortable that that's probably the case, and you might be thinking, well, if the high is really old, blah, 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 there's not going to be orders there. There is. Trust me. Above every major swing high, every major swing low, every relatively equal high, every relatively equal low, there's going to be a large amount of orders there. But what does this do for this particular person that we're talking about? Well, imagine I'm somebody with a ton of money. And let's say that there's, in this market, let's just say that there's $100,000 worth of stop loss orders above this high. First and foremost, I can't know that for sure, okay? But let's in this case assume there is. And me as a trader who doesn't know that information, but also understands that humans typically do put their stop losses above old highs and beneath old lows, okay? And let's just imagine the same thing is true down here. It would make sense for a very large trader to continue a trend by running into those highs and lows before the trend continues. And the reason is because stop loss orders when you short the market are buy stop orders. Okay, so they're actually buy orders above this to buy their short position back. Okay, and orders below the market right here, these are sell stop orders to sell the position that they bought. So we could understand with a fairly decent degree of certainty that there's a lot of buy orders above this high and that there's probably a lot of sell orders below this low. And beginning to identify the particular highs and lows where it's very likely for people to put stop losses kind of creates the foundation for the entire edge and the foundation for a liquidity sweep in total. Okay, so when we talk about a liquidity sweep, let's say I have $100,000 to buy the market. If I buy the market right now, or I want to sell the market, I want to see the market go down. But if I sell the market right now and short it, the price will drop, but my average fill is going to be down here. And I don't want my average fill to be down there, because that's just giving me a worse fill on my position than what would be reasonable. What would be smarter for me would be to let price push up until it ran right into this high, right above here, and then use all that $100,000 worth of buy orders to be my counterparts to a big $100,000 short order up here, and then the market could continue going down. So, whereas traditionally you would say, well, you want to create higher highs and lower lows, on a much bigger sense, maybe that is true, but in this case, maybe that's not true. In the sense of, well, I have a big short order that I want to execute. I could be somewhat confident that there's going to be a lot of buy orders above this high in the form of buy stop orders. If I could run the market into that high, trigger all of those buy orders, it's going to flood the marketplace with a excess of buy orders, and they need a counterpart, and I'm going to be that counterpart to short the market. And where am I going to take it down into? I'm going to take it into a opposing level of liquidity, which is what we call these old highs and old lows. They're liquidity levels, because we're assuming there's going to be an excess of liquidity above and below those levels in the form of stop losses. So if I short 100,000 here, where do I also know I could reliably exit that position without getting slipped? Probably below an old low as well. So this is the theoretical reason behind liquidity sweeps and why we use them. And now let's get onto the charts and look at least a couple examples for each side. So as a rule of thumb, you're always going to be looking for liquidity sweeps opposite to the trending direction of the market. So if I believe that the market's going to go higher, for example, if I believe that the market's trending higher, I'm going to be looking for market to sweep lows in order to take liquidity. And just look, every single time, okay, in this case we create a low, market sweeps it, right? We create this low, market doesn't sweep it. Here's a swing low, market runs that low. Here's a swing low, market runs that low before going higher. Here's a swing low, market runs that low before going higher. Here's a swing low, market runs that low before going higher. Every once in a while, you'll have one that stays in place. And as we get further on, we'll talk about when to maybe discern if it is going to stay in place or if it's not going to stay in place. But generally, we get these lows, market runs it before going higher, right? And the reason for that is because, again, imagine I want to get involved in this trend, right? I think that the market's going to go higher. If I want to get involved in this trend and I have a ton of money, I need to find a place where there's reliable liquidity. Well, here's a low. I'm sure that there's stop losses underneath that low. Here's a low. I'm sure that there's stop losses underneath that low. Here's a low. I'm sure that stop losses underneath that low. So in a very strong uptrend, every low that gets broken, seemingly you want to see those get bought, right? You want to see every low that gets broken get bought up in a very strong uptrend. And this happens over and over and over again throughout all of history on all high time frames. One thing to be very aware about here, though, is that notice how that's not really the case on the top. Every single time the top gets ran, it's not really getting swept. In this case, maybe it's coming back down to the opposing liquidity, but a lot of these highs are just getting ran right through. And that's because, again, liquidity sweeps really only work opposite to the direction of the trend that the market is going in. If the market is going up, you're expecting buyers, people who want to buy the market, to want to push it below old lows and buy up the liquidity, buy up the sell stops, and be the counterpart to sell stops underneath those old lows. Does that make sense? Let's take a look at a strong trending down market, for example. And even from the very beginning, you'll start to see, right? As the market's starting to trend strongly down, we have highs, swept, ran, highs, swept, ran, highs, swept, liquidity taken, right? And you'll notice in very strong trends, this is one of the most common occurrences ever. And sometimes you'll see things like this too, where a high doesn't get taken. But again, in just a moment, we'll talk about how to find high probability levels where liquidity sweeps will occur. And you'll understand that this was the right high to be looking at in that moment. Highs swept taken, high swept taken, high created, swept, moves down, right? In very strong trends, this is just what happens. And most people will have you believe that this is not what happens. And most people are completely wrong. And they'll say, well, in a strong downtrend, you want old highs to stay intact. And again, while that may be true in a very big sense, in every strong trend, the exact turning points of the market are mostly going to be these liquidity sweeps, where, again, in the short side, in this example, anybody short here, short here, short here, we understand that there's probably a lot of stop losses built up above this. Anybody that shorted on a new break, anybody that shorted prematurely, anybody that's trying to short the pullback right here, we could assume that their stop losses are going to be above this high. And what are those stop losses? Those are buy orders. So if I'm somebody with a lot of money who wants to short the market, it would be in my best interest. It would be in my best interest to run right above that high and sell to those buy orders so I can get my order filled before the market actually continues lower. You see what I'm saying? So this is how to somewhat identify liquidity sweeps on a very bearish and a very bullish trend. Now let's talk about how to find the most probable highs and lows that are going to be what you want to see for an actual liquidity sweep. So it's honestly pretty simple, and it boils down to generally one of two things. You're going to want to see equal lows or some sort of collection of a bunch of lows in the market, right? If you see something like this, it's a big likelihood that the market's going to run below it before continuing higher. And the reason is simply because, again, I know there's going to be a lot of liquidity here. Think about it from a trader's perspective. Everybody uses this as support. This is exactly what people want. Like, people are going to see this. They're going to say the market's holding. This is a perfect spot for the market to hold. Everything looks good. And people are going to be piling stop losses underneath all of these lows. Whether it be this one, it might even be higher, or even like here once it pushes. But the vast majority of the stop losses, if somebody's participating in this range, are going to be right underneath this low. And as traders, we could take advantage of that information and either intraday try to find a setup to get involved in a run. Maybe we're entering short here or entering short up here, trying to push ourselves down into here. Or if we want to get involved with the overall trend, we should wait. We should wait for this liquidity sweep to happen before we get involved in the market. Now, there is also an argument here where for every equal lows or equal highs that you sweep, for every liquidity pool that you sweep, you also had to create that at some point. So there is ways, and again, as we get future into this course and into this talking, you'll start to understand how you could anticipate if equal lows are going to be generated or if they're going to be swept. And so I'm not saying you cannot play the generation of equal lows. You can. That's a setup that you could play. But really, majority of good setups are going to come after a liquidity sweep. And the reason is because this low now becomes quite a protected low, right? Because if you think about what I'm saying, this is in theory, and again, we'll never truly know this because we just don't know who the market participants are. But in theory, this is where the big participants in the market just stepped in. So they have a vested interest to keep this low intact. They just bought up all the sell stops. In theory, they're filled with very large orders. And this is the low that they're going to want to protect in the market, at least until price travels to the other side of the range or some sort of opposing liquidity where they're going to then unfill their order. They're going to exit their position or hedge their position. In reality, the market works more on hedging than actually using take profits. But that's a completely different story in total. And so these areas where you have relatively equal lows is one very major point of liquidity. So let's go into the charts quickly, take a look at what that might look like. Okay, and these are everywhere, by the way, literally everywhere. So when I say relatively equal, what am I even talking about? I'm talking about highs that are generally grouped together. Okay, I'm being so real. Don't try to turn this into a science. There's not a mechanical rule for this. I promise you will get a feel for this. all these highs are kind of grouped together. You see what I mean? They're all relatively equal. Yes, one of them went higher, one of them was quite a bit lower. They're not perfectly equal. Visually though, put yourself in the mind of a support and resistance trader. I would put my little box, I'll be like, oh my gosh, the market found resistance right here, and then it pushed. And you could generally expect that to get held off once, right? Because those people need to get in the trade short. Now, anybody who just used that area as a support and resistance zone has their stop losses right above this high. Me, as somebody who wants to take advantage of that information, it would be wise for me to run right above that high to a particular level, which you'll learn about later, and use those buy stop orders to get filled in my short position. Price falls down. Here we go again. We have relatively equal highs. What do I mean by this? All these highs right here. Why? Because this whole range, it's been holding, it's been holding, it's been holding. This is all relatively equal. If you just view it, again, view it at the stance of a support and resistance trader, okay? These people will say the market rejected here, it rejected again, that is now resistance. So we're going to short on this push, or we're going to short on this push right here, and as we short the market there, our stop losses are going to be right above this high where this red line is. And this is going to be the perfect time, the perfect spot for you as a trader, if you were a very large trader, to run the market up into the high, use those sell stops to go short. So anywhere you see relatively equal highs, like to me, this is also relatively equal. Even though this is not like the perfect thing in the world, to me, this is relatively equal. Yes, this low is much lower than this high. This to me is still relatively equal. Again, it's not a perfect science at all. If I'm being totally honest, it's not a perfect science at all. However, it's very easy to spot. And I think within, I don't know, a week of looking at the charts and looking at liquidity this way, you'll start to very easily be like, yeah, well, this is clearly all relatively equal. If the market wants to continue lower, it makes a lot of sense to just go run those highs real quick before the market sells off. So that's the main way to identify very clear points of liquidity. The other way is if you have very long-term highs and lows in the market. So if you have very long-term highs and lows in a market, or a high and a low that led to a breaking of a different level. So what do I particularly mean by that? For example, if you have this level, for example, where you have this high that broke this low, but then you came back up into the range. Yes, this is a single high, but in my mind, this whole thing could be used as a liquidity sweep. Now you notice we reject off of it. What does that create? Equal lows and equal highs, which is the primary thing, by the way. We are primarily looking for equal highs and equal lows. So don't take this whole important high or low or long-standing high or low thing into too much account. We're primarily looking for equal highs and lows. Another thing is something called trim-based liquidity. So notice how in this whole rundown right here on this time frame, we create highs, we create swing highs, and they're not really getting taken at all, and the market's just crushing in one direction very hard. Some people might say this is a channel, some people might say whatever, but very often when you see this type of price action, if you get a run up into that whole range that eats up most of that very strong trend, this is also a form of a liquidity sweep, because you have to think every single person that was short on this trend, betting that their stop losses are going to be safe above these levels, are now getting stopped out, unless their stop loss was like way up here. But then even internally, you're going to see more clear equal high and equal low setups happening inside of here. And even here, you'll notice, well, we create equal highs with price action right here and here, and then that's actually where the final sweep occurs. So again, the primary thing that you're going to be looking for high probability liquidity sweeps is equal highs and equal lows in the market. All right, so let's take a market like this. Let's say that you have a pre-decided bullish bias here, right? For whatever reason, you're bullish. So in the future, this might be for the reason of PDRs. This might be for the reason of you're just holding over levels. For whatever reason, let's say you're bullish. So you're watching the market right here, and you identify this range where you think that price could just run right underneath here because you think that there's stop losses underneath this low, which is fine, right? Let's imagine that the market's been very trendy. So let me just draw this backwards. The market's been very trendy. So the market pulls back. People are buying here. People are buying here when it looks like it's holding. It leaves this low. It leaves relatively equal lows, right? All these are somewhat equal. The market can then run these lows. And you're saying that this is liquidity. How do you know if that liquidity sweep is going to sweep again? So this is a very common question that I get. Well, if you sweep those liquidity levels and you get back above the low that you swept, think about what this means. If the market's primary drive is to seek liquidity and it gets back above the lows it just swept, so it starts trading up here, for example, now we can understand that the market really has no more reason to be back underneath this low. Why? Well, simply because if this little section of price action right here is technically confirmed to be a liquidity sweep, then why should the market come back underneath it? If there's no more liquidity for it to get, then there's no more liquidity for it to get. It already swept liquidity. So if it's above it now and it comes back to that level, you want to see some sort of sensitivity off this level. Now, retests of liquidity like this will happen 60% of the time. So 400 times out of 1,000, the market will not come back down to a liquidity sweep and retest it. 600 times out of 1,000, so more often than not, you will get this retest. And this retest is very telling. If you get a lot of sensitivity here and the market doesn't want to push lower at all, that's kind of your key that this is actually a sweep of liquidity that's holding, because the market is not showing a willingness to push down here again. Which, why would it? Because in theory, it already took liquidity. So why does it need to go down there again? So if you see sensitivity here, it could be a good sign that the market's ready to actually push higher. Now, let's take another example though. Imagine you don't get that. So you same situation, you're bullish for whatever reason, market pushes down, and now let's take the next situation here. So the market's pushed down, you're assuming this is going to be a liquidity sweep, but then you get up to those lows and you can't get above them at all. You can't get above them all. Maybe you try again, you can't get above them at all. This becomes very, very suspect, because what this tells me in my brain is that they wanted to use these lows and the level and the stops underneath them. They wanted to use this as liquidity to buy the market up, especially if we have a pre-existing idea that we're bullish. However, for whatever reason, this sweep of liquidity was not enough, because they can't even push the market back above the lows that you swept. So, if this is the case, I think in this particular case, you have to be very, very careful and maybe assume that the market might want to sweep again and run lower into those lows before finally coming up. And the reason being is because rejecting right below that level like that is more or less telling you that, hey, the market couldn't find enough liquidity underneath this sweep right here. So if it can't find enough liquidity underneath this sweep, then probably it's going to go down again to take more. So this becomes the most aggressive way a market can hold down. And this is why sometimes just typical support and resistance works, right? This was supposed to be a liquidity sweep. It gets rejected right at the moment where that would be confirmed. And that's what causes a lot of aggression down in the market very often. So, but what about a situation like this, where it pushes up, it comes above, it holds, and then it slips under? This is the same thing. Again, if the market's primary function is to sweep liquidity and go where liquidity is, it just did it on this dump. So if there's truly nothing left underneath here, why is it that the market is having a hard time holding back above this level? If the market had no reason to go anywhere except taking liquidity, why is it doing this? Why is it getting back underneath that level? In my opinion, if you don't want to be longing in this section of the move, you need to be only taking a long position above where the liquidity sweep happened, right? Because now you're threatened with this. And if it can't get back above this level, it's probably going to go take this low. And I would be very cautious of any longs in this range right here. And it might hold. right? There could be a case where you come down, hold here, and then get back up. But I would rather, in this case, be more cautious and take a position back above this level than ever taking a position below where the liquidity actually swept. So hopefully that makes sense. Let's go on the chart and see a couple examples of that. Righty, so here we go. This is an example of a chart where you have very clear equal lows, right, in this whole range of price, okay? And then the market sweeps those equal lows. Not to mention they even sweep the lows even way down here. But in this case, again, I think you should always prioritize the more clustering of candles as the actual liquidity sweep that you mark. The market pushes here, it sweeps all those lows, and then look, on its way back down to that level, there's sensitivity. It doesn't need to mean that it tests that level perfectly or whatever. But when I see sensitivity moving away from this, this really helps me believe that this is probably going to be a liquidity sweep. But even before that, look what happens. We sweep these levels, we get a nice close above, and market comes back down. And in this minute, this looked like a big bearish down candle, but look where it stopped. It stopped right on the retest of that liquidity level. And when I see this, this makes me believe that the market is likely to respect this low. Okay, does that make sense? It makes me believe that the market's very likely to respect this particular low right here because it is not getting back under the level that liquidity swept. And if it's not getting back underneath the level that liquidity swept, it's very likely to push higher. So use another example here, and this is a bearish example, right? The market creates this whole section of equal highs right here, okay? And that whole section of highs here gets swept. And then notice, and again, by the way, you want to be using perfect levels for this. I'm just doing this for an example. The price tries to push back up there, and it completely fails, and it sells off. Versus what happens down here, where the market sweeps those lows, and when it comes back, first and foremost, it holds off the very first thing that exists. It can't break even one new high. It's testing deeper and deeper into this low. This is telltale signs that the liquidity sweep is probably failing. So we'll learn how to use liquidity more as time goes on, especially in an intraday scalping way. But hopefully this starts to open your eyes and let you see how to use liquidity, how to identify liquidity sweeps, why they're important, why we use them, when we use them. So we're only looking for sweeps of lows when we're in a uptrend. We're only looking for sweeps of highs when we're in a downtrend. And also how to know at least a little bit when a liquidity sweep is in succession or in failure, and even some percentages on that. Again, as we go further into these videos, as you learn more about what's going on, you will be able to understand this even more. But hopefully this is a very good introduction to liquidity, and this is also the foundation of everything I do, right? A liquidity sweep is one of the key pillars in every single trading setup that I will ever take. So hopefully this helped you. Fair value gaps are one of the more influential parts of technical analysis that I use, and in this video I aim to make this the last video you'll ever need to watch on them. So I've been trading for a very long time now, and I'm going to tell you every single piece of knowledge I've ever gained about fair value gaps, how to utilize them, how to gain insights if the market's going to be aggressive or not, obviously how to see them, and then some tips and tricks that I've learned over the years that I have utilized them. So this video may end up being a little bit longer than normal. If you would, like the video, subscribe, and join the Discord in the description. And without further ado, let's get into the last video I think you'll ever need about fair value gaps. So, as all things do, it starts quite simple. And the first little bit is going to be some of the baseline stuff that you've probably seen everywhere and everybody talks about, but we have to go over them before we could get to some of the more advanced use cases and some of the more, I guess, interesting talking points when it comes to fair value gaps. So what even are fair value gaps? At the very lowest level, it's a very, very simple thing. It's borderline a candlestick pattern, and it's just 3 candlesticks. Here we have an example of a bullish fair value gap and a bearish fair value gap. So whenever you're looking for a fair value gap, again, it's just a 3-candle pattern. And the main thing that you're looking for, and not even the main thing, the only thing that you're going to be looking for is in a bullish example, you're going to be looking for the first and the third candle to not have wicks overlapping. So what I mean is look at the top wick of this first candle and look at the bottom wick of the third candle. Notice how if you draw a box between those two levels, there's a gap, right? There is a box to be drawn. This second candle, there's a huge portion right here where these wicks don't overlap. What would not count as a fair value gap is, for example, if the wicks do overlap. Now you have nothing in this second candle between the first candle's high and the third candle's low. You don't really have anything. And there is no gaps here. There's no range that you could draw something. But when it's like this, and the first candle's high and the third candle's low produces this gap, this is a level that you could draw. And in the future, you could, more or less, you could just expect it to act as support. Okay, I know some people get triggered when I say support and resistance because some people don't like those terms, but more or less that's what it is. Now, there's a lot to fair value gaps. There's not a lot to defining them, but there's a lot to them. And there's different levels inside of them. Those levels have different meanings. There's times where you can anticipate a fair value gap staying open versus getting traded into. And there's even situations where you're going to mark them differently. But first, let's talk about bearish fair value gaps because it's the same thing. So again, a 3-candle type of pattern. On the first candle and the third candle, these are the important parts. If the first candle's low has a difference from the third candle's high, then there is a fair value gap present. Okay, you're looking for a piece of price action in this isolated 3-candle window where these wicks do not overlap each other, and that's going to be a fair value gap. When price retraces and trades back up into that level, you would expect and anticipate it to potentially act as resistance. Okay, again, there is more things to it. Now, one thing here is if you have this tiny gap here or this tiny gap here, let's just make this example a little bit different. You're going to mark your fair value gap different. So if between the first and the second candle, you have this, which is referred to as a volume imbalance, which we will talk about also in this series, or you have a volume imbalance here, what you're going to do is you're going to bring your Fibonacci tool and pretend like you mark the fair value gap from the volume imbalances. If neither of the wicks pierce the halfway point, then you are going to mark the fair value gap from the volume imbalances like so. If you try to draw that Fibonacci like this, but one of the wicks pierce the halfway point, then you're going to mark the fair value gap wick to wick, and you're not going to include the volume imbalances. And this is the same thing for here. So again, if it has volume imbalances, you're going to test it. If you notice that, hey, if I would have drawn it like this, neither of the wicks are piercing that halfway point, great. Now I'm going to expand my fair value gap to include volume imbalances. If one of these wicks were to pierce the halfway point of that Fibonacci, you will not use the volume imbalances. Instead, you would mark the fair value gap like so. Hopefully that makes sense, okay? You have to be able to mark fair value gaps correctly before you could utilize them correctly. So let's move on now. And by the way, going forward, all examples, I'm just going to use bullish fair value gaps, but just flip it on its head for bearish fair value gaps as well. So the first question that I often get when it comes to fair value gaps, especially from newer people, is how long do you keep them on your chart? And the answer is quite simple. You keep them on your chart until they get closed under. But even when they do get closed under, they turn into something called a inversion fair value gap. So typically what you're going to see is you're going to see price action just hold these fair value gaps. It's going to trade down into it to a particular level, which we will talk about very, very soon. And it's going to ideally hold that fair value gap and move higher. However, price moves up and down, and sometimes you're going to get a big down candle like this that's going to close underneath that fair value gap level. At this point, and again, if you're looking at a bearish fair value gap, you would be looking at an up candle closing above. At this point, this will become a inversion fair value gap, and instead of holding price up, you would expect price to open up, trade into this, and then sell off in this to hold price down, that range to hold price down. And that's really how a bullish fair value gap turns inversion. A lot of times you're going to fill up that inversion fair value gap. You could tap just the outside. You could go halfway. You could do many things. But this range of price, after it gets closed under, it becomes an inversion fair value gap. And then if you close back above this level, that is when you could fully remove it from your chart and it no longer has any relevance at all. So fair value gaps all go through two stages. It becomes a bullish fair value gap that holds you up, and then it becomes a inversion fair value gap, which is a bearish level. And then if you close over it again, that then becomes a irrelevant fair value gap. And by the way, just so you know, we will go over real chart examples as well. I personally feel like it's important to go over a lot of theoretical examples first so that you very easily understand what we are showcasing in the future. So when do you expect generally a fair value gap to be traded into versus left open? And when I say left open, I mean we never trade back into that fair value gap. Well, one way to determine this, and there are multiple when it comes to higher time frame levels and things of that nature and full setups and different things like inside bars and things like that. But in this example, and probably the most common way to tell, is if you want a very aggressive expansion. Imagine you're expecting a lot of aggression out of a market. The very first fair value gap that it creates at the bottom, typically in the most aggressive market conditions, will generally stay open. So that leads your eye to looking at the second fair value gap that gets created right here as potentially the one that's actually going to hold. So what I'm trying to say is in the most aggressive market conditions, what you'll often see is something like this, where that lower one never gets traded into, and the higher one is the fair value gap that gets traded into. And the fact that this does get left open in itself can have you anticipating aggression. And in fact, in a lot of my trading setups, one of the things that I oftentimes look for is a fair value gap to be left open to confirm my suspicion of aggression. Or also an immediate rebalance also does that role for it, which we will learn about in a future video. Okay? So this is one way to anticipate if a fair value gap is going to be left open. If you really, let's say you really expect the market to run into this level, maybe it's a level of liquidity and price pushes up, you create a fairly small candle right here, you're expecting a huge amount of aggression going higher, and you have two fair value gaps to choose from, very, very often in the most aggressive moves, the bottom fair value gap here will be left open. And again, we will show many examples of this in a moment. Alrighty, another common question that I get is which fair value gap do you use in a situation like this when it comes to an inversion fair value gap? So in this situation, for example, we have price action falling through and closing underneath two fair value gaps in the market. Which one do I think is highly likely to act as an inversion fair value gap? Well, the answer is very simple. Which one held price up? So notice how this higher one held price, held price, held price, held price, held price, right? This is at the actual level that held price up. In this one, it just fell dramatically through and immediately turned inversion. So to me, although this level is, it really is a inversion fair value gap, it's not like it's not. To me, the higher likelihood is that price will more often than not try to push back up into the level that actually held price up in the past and then broke down. So more often than not, you'll see price go for the inversion fair value gap that actually held price. Hopefully that makes sense. And on a lower time frame, imagine this was a daily chart, and this is just getting into the future, something that I won't even really cover in this free YouTube course, which by the way, join the Discord if you want to. You could use the PDR levels inside of this range intraday on this market opening bullish to bring you up into the inversion fair value gap. And PDR in total is something that we will talk about not on this YouTube channel, unfortunately. I'm going to give you a lot of information in this free course, a lot more than I ever thought I would, to be completely honest. I'm not going to be talking about PDRs though. Because PDRs are my baby. I created those motherfuckers. They are my baby. So I'm very protective of them. Not going to be talking about them here. But I will be giving you more information than probably anywhere else on the internet about all these technical analysis concepts in this free YouTube technical analysis course. So yeah, whenever you're deciding which fair value gap to pick as inversion, in my opinion, always prefer the one fair value gap that actually held price up. Or if you're looking at a bearish example, and you're looking for what you should use as the bullish fair value gap when it turns inversion, always prefer the fair value gap that held price down to turn inversion to then use as an inversion fair value gap. And in the future, we'll talk a little bit, but in this particular example, and not to get it too complicated, you would be actually looking at this wick right here, and you wouldn't be considering that fair value gap at all. You would be looking at the levels inside of this wick. And we will have a video on wicks coming up in this technical analysis series. For now, just to keep it simple, that's the fair value gap, and that's how I would pick. Okay? And once that video with wicks comes around, you'll see why this fair value gap is a little bit suspect. If it was like this, it would be totally fine. But once it's like this, we use this wick. Again, don't worry about that for now. I will deep dive that once we get into the videos about wicks. And now perhaps the final theoretical thing to talk about before we hop into chart examples is that there is 3 levels inside of every single fair value gap. But please be aware that the level itself is the fair value gap. If you don't trade into any of these levels at all, but you still trade into the fair value gap, you are still holding the fair value gap. The fair value gap itself, the entire range of price, is the level. The 3 levels inside here are just points that price very typically trades to inside of a fair value gap. So you may see it trade to the 25% level, the 50% level of the gap, or the 75% level of the gap very, very, very often. And also holding the high end and the low end. Now, this fact right here is actually what inspired projected fine ranges for me. So, you know, there's a little hint for people who want to see if they can figure it out themselves. But beyond PDRs, every single fair value gap has 3 levels. And generally, the most aggressive way for a fair value gap to hold would be to stay within the upper 25% like so, never even violate the 50%, or wick all the way down beneath the fair value gap and then end up closing above it. That's the single most aggressive way for a fair value gap to hold. When you start to have a little bit of doubts, for example, if you see something like this and the candle closes inside of that fair value gap, that becomes a little bit sketchy. And it becomes even more sketchy if that candle closes anywhere beneath the halfway point. At this point, I would start to anticipate this is probably going to turn inversion, or at the very least, if it doesn't turn inversion, I think I would pass on an entry inside of this fair value gap and wait until price pushed a little bit higher back outside of it to confirm that this little bit of failure wasn't going to turn into a lot of bit of failure. So I think these are many, at least, of the theoretical questions on fair value gaps. So now let's go ahead and go onto a real chart on real price action and see some real examples right now. And by the way, just so you know, any questions you have throughout this entire series, throw it in the comments. I'll try to respond to you. Alrighty, so I'm just going to show you a couple examples of default bullish and bearish fair value gaps just so you can get your pattern recognition working. And then we'll show you some examples of inversions, and then we'll show you some of the niche examples that I just spoke about. So here, again, notice how we have volume imbalances connected to where this fair value gap would be. Go ahead and mark this with the volume imbalances, and notice that neither one of these wicks pierce the midpoint. So that means we're going to mark this fair value gap like so. Okay, drag this over. Let's make this a better color. It's a little bit hard to see. And there you go. That's going to be a bullish fair value gap. And price is typically going to trade down in there. And notice, again, even on this leg of the move, price never traded down into that first fair value gap. It's more likely for this to follow through into a aggressive part of price action. And price keeps going. The next set of bullish fair value gap that gets created is right here. And notice the same thing. Price trades down into it, trades down into it, trades down to it, pushes higher, and there you go, right? Easy, fair value gaps, exactly how it should be. In this one, it doesn't run again. And then we sweep liquidity and we end up starting to create a downtrend. Okay. But this is one example of bullish fair value gaps. Let me go find another example. Then we'll do two examples of bearish fair value gaps. Then we'll look at inversion fair value gaps and everything in between. Alrighty, so here we go. We got a very aggressive move that has a lot of fair value gaps. Okay, a lot of them get created here. This one is closest to price. You mark this. Again, let's imagine if we were to use this volume imbalance, this is a problem now. Because look, that wick, does it pierce 475.25? I like that we just encountered this example. If you look up in the top left, notice how it says the H, which is the high of this candle, is 19,475.25. So it's exactly that halfway point. It does not pierce that halfway point. So in this particular case, we can indeed mark it from the volume imbalance itself. And that's going to give us this particular fair value gap right here. And as you can see, price trades down right to the halfway point. Again, we're not going to be talking too much about the levels inside, but know that they are there. And then we have another fair value gap that's created here. This one doesn't have a volume imbalance. See, you do have a volume imbalance there. You don't have a volume imbalance there. I could see visually that the wicks will not meet the halfway point. And if you drag this along, this is going to be your fair value gap. And you might be wondering, well, you traded all the way through the fair value gap. Why are you still using it? Because you can still use it, right? You never closed underneath this fair value gap. This is totally fine. And then you'll notice how once we close back above that halfway point, it starts stepping up through the levels inside of the fair value gap, which again is the foundation of PDRs. And you can see how that works, right? And then you create the very next fair value gap right up here, where you have, again, one created down here, and you have another one created up here. I could tell that the wicks are going to intersect, so this would be your fair value gap. Yes, I understand it's a very small range. It's allowed to be a very small range sometimes. Notice how price digs in, digs in, digs in, digs in, digs in, digs in. But that lower fair value gap never gets traded into, right? It never gets traded into, and that typically leads to a bit of an aggression expansion. In this case, it did aggressively expand to go take out the highs. But this is how you could start to identify bullish fair value gaps on your chart. Let's now go and identify bearish fair value gaps in the market. And by the way, it should be known right now that bullish fair value gaps are going to work when the market is trending up, and bearish fair value gaps are going to work when the market is trending down. Don't be the person that tries to short bearish fair value gaps or bearish levels in total while the market is screaming higher. Don't be that guy, okay? You need to use these concepts in following of the trend that is going on in the marketplace. So here we go. This is a lot of examples of bearish fair value gaps, but you'll see the very first one that we create at the top of this move, we create, price trades all the way into before a big dump, and then we have another fair value gap created right here. Price trades, fills the whole thing up, gets traded into, sells off from that fair value gap, price moves again. We have another fair value gap here, and in this case you could use that volume imbalance. Price fills up all the levels inside that fair value gap and then dumps off even further. So you can see how we could start to use bearish fair value gaps in an aggressive trend to catch very aggressive continuations, for example. And I'm looking for hours when the market's actually open. Here's an hour where the market's actually open, where we have a lot of bearish fair value gaps again, where, for example, this top one right here, bearish fair value gap, price trades into it, and then the next fair value gap bearish that gets created right here, price trades into it, fills it up. And if you start to mark the levels inside of these, you'll notice that price is, even you go all the way through, trade, 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 boom, right? Here on this top one, you go all the way through, trade up to this one, trade out, trade to the halfway point, sell off, right? But these are the fair value gaps. There's also order blocks and things like that in this range. Realistically, as you'll see by the end of this course, most of these internal things, most of these internal fair value gaps, 1 minute fair value gaps, 1 minute order blocks don't really matter, and they're kind of overarched by high time frame levels. However, you know, you got to learn it somehow, and we're going to learn it with the use of interior price action for now. By the end of this course, you will learn exactly how I use all these ideas to specifically target high time frame levels, though. I promise. Okay, you're not going to leave this course without that information. Not the free course. You're going to learn exactly how I do things on a high time frame. But yeah, this is how you mark bearish fair value gaps, for example. So let's get on to inversion fair value gaps now and how to see those. All right, so here we got an example where we have a fair value gap right here that was a bullish fair value gap. and this held price, held price, held price. And then the moment that it closed underneath this becomes a bearish inversion fair value gap. As you can see, price returns back in, sells off, sells off, sells off, and it leads to a big sell-off. And we can see those all the way down, right? We have another fair value gap here that we would mark, bring this over. The second that you close underneath it, comes back up, trades to the high end, trades back in, trades back in, trades back in, sells off, okay? So this happens over and over and over again, and you're looking at this side of the marketplace to see those. But even inside of here, right, you have a little fair value gap inside of here on a bearish trend. A bullish fair value gap gets created on a bearish trend, and notice how price comes up. Yes, the wick does pierce. However, we never close. We never close, and that's more or less kind of the important thing about stuff like this. Okay, so this just happens over and over again, right? It just happens over and over and over again. And for example, you have this one big fair value gap right here that's been holding price down for a while. Price closes above it right here. You bring this over, and notice how after it closes above, comes back down, and it uses that fair value gap in a bullish context to launch the market higher. Okay, so there you go. That's really all it is with inversion fair value gaps. It's just a case of if it's a bullish one, it could turn bearish on the other side. If it's a bearish one, it could turn bullish. Again, I really don't want you guys, what I do not want you guys to do after this video is to go and start marking every single 1 minute fair value gap. I'm going to let you on a little bit of a secret. I have never used a 1 minute fair value gap in my trading. That's a little bit of a lie. 99.5% of the times, I've never used a 1 minute fair value gap ever in my trading. And by the end of this course, you will see exactly what I mean and how to make sure that you're prioritizing high time frame levels, pretty much exclusively. So, to be honest, that is mostly it when it comes to fair value gaps. A lot of people try to make it more complicated and say, these are the ones that are more high probability, blah, blah, blah. But I'm telling you, the people that tell you that, in my humble opinion, as somebody who has made something like $10 million trading the market, so that's more or less it about fair value gaps. There's a lot of people that'll tell you more information about them. This is how you could do it more high probabilities and stuff like that. As somebody who's made over 8 figures in the market, I'm sorry, I don't want to hear their opinion. I do not care about their opinion at all in any way, shape, or form. However, again, we're going to go through the structure of this course we're going to go through every single type of level that I use, and then I'm going to show you how I actually mark levels. There is a difference because I very prioritize high time frame levels, and that's where the probabilities of these things are really going to shine through. So stick around for all these basic, this is the technical analysis, this is how you market type of videos, and then by the end of this, you're going to have a complete system of marking levels that is probably better than any system for marking levels that is even on the internet. So without further ado, hopefully this helped you understand fair value gaps a little bit more. Hopefully it helped you in general, and I'll see you boys later in the next video. This video is going to be on Wicks. Now, Wicks are a pretty foundational part of how we do technical analysis, or at least a part of how we do technical analysis. I wouldn't necessarily call them foundational. And what I mean by Wicks is specifically bigger wicks in the market. So you see things like this, it's a relatively big wick compared to everything else. Things like this, a relatively big wick compared to everything else. Things like this, a relatively big wick compared to everything else. Things like this. So we're going to get a little bit more nuanced in this video, and we're going to be using this little bit of technical analysis that I went through and made, right? These are all rectangles. This isn't a piece from a chart. This is something I made for demonstration purposes that should showcase every single use case of wicks in the market. So again, the very first thing, I guess not again, but the very first thing that we have to talk about when we talk about these wicks is what they stand for and kind of what they are. So they're basically the same thing as fair value gaps. And in fact, you treat them identically to fair value gaps. So whenever you have any wick, so right now we're talking about any wick in the marketplace. Okay, any wick in the marketplace is the same as a fair value gap. Now, this might be slightly confusing too, because you don't see me looking at every single wick in the marketplace. And that's because if you looked at every single wick, you would have about 5,000 levels on your chart, and it would be completely useless to you. So there would be no universe where we sit down and we look at every single wick of every single candle. So there has to be a few criteria in place that that kind of dictate what we're looking at, what we're not. It's not like a fair value gap where they're kind of rare. Wicks are in every single candle, right? So we can't just look at every single one, and that's the very first important part of this. We have to come with a set of criteria. So I'm going to lay out a set of criteria. Now, the criteria that I use when I look at Wicks is really simple. I have two things that I'm looking for. They're big relative to the surrounding price action, relative to the surrounding wicks in price action, not candle bodies, and they're either created from a high time frame level, from a test of a high time frame level. So you could imagine, for example, like this middle wick. In this case, you traded down into it, or you traded down into it here. Anyways, you push through it, you close the candle body above, you create this relatively big wick from the test of a high time frame level, and the wick is relatively big compared to the wicks around it. This would classify as one that I would look at, versus something like this candle right here. This isn't created, well, in this particular case, we don't have everything, but in theory, if there was no high time frame level here, this isn't created by a high time frame level. And even if it was created from a high time frame level, this wick is not relatively big to the surrounding candles. Okay, so these are the two kind of main filters that I use, and I really only look at wicks that meet these two requirements. Again, they have to be big relative to the surrounding candles, and they have to be created from a high time frame level or something of importance. We'll talk about that of something importance soon in this video, so you'll see what I mean by that. So if that confuses you right now, don't worry. Okay, so if those two criteria are true, then we can treat a wick just the same as we treat a fair value gap. Okay, so going into this video, we're going to walk through this whole section of price action that I created, and we're going to not talk about how to enter them and where your stop loss placement is going to be and stuff like that. I'm noticing that I'm missing a wick on this candle, so I'm very I'm very particular when it comes to this stuff, which is also another video that I want to make. Is if you could create and kind of draw very good looking price action, you probably understand it. So we're going to go through this whole section of price action here, and we're going to work on identifying them. We're going to talk about some intricacies in this price action. I've built in some edge cases and some topics that I want to talk about pertaining to wicks, and I'm also going to have, probably the next video after this, a entries video all about wicks and how we enter them and things like that. But we have to get through the technical analysis part first. So just going through this video as well, just keep this in mind, right? These are the requirements for me to even consider a wick. But also keep in mind that every wick is technically treated this way. Every single wick in the market is treated as a fair value gap. This is like a huge revelation to some, but again, understand the reason why we don't use every single wick. Because if we did, it would be mayhem, right? There would be about 50 quadrillion fucking wicks everywhere at all times, and not all of them hold, and you would have very bad results, and there's no filtering, and it would just be terrible. Okay, it would just be absolutely terrible. So let's start walking through this price action. So let's say, imagine price was pushing up, you fell down, and boom. So price comes up, you fall down. At this particular moment, let's say you had a bullish bias, okay, and you just traded into a high time frame level. Now this could be a daily, this could be anything. Basically the highest time frame that you have access to. You all know what I mean when I say high time frame level. At this point, when this candle closes, not before it closes, notice how this candle's wick, the bottom wick of it, is substantially bigger than any other wick in surrounding price action. And it trades into a high time frame level. So that meets all the requirements for us to treat this wick like it's a fair value gap. Okay, and we'll go back to this one in a second. But let's say now that meets all the requirements, we can treat this wick like a fair value. So what exactly does that mean? Let me make this green. The colors don't matter, by the way. So let's imagine, sorry, I'm weird with stuff needing to be right. Let's imagine, okay, so this meets the requirements that we talked about. It's bigger than the surrounding candles, and it trades into a high time frame level. We can now treat this as a fair value gap. So what that means is you all of a sudden have all the levels just like you would in a real fair value gap. That means you have all three levels in it. right? We've talked about this with fair value gaps. Same thing with Wicks. You have the 75%, you have the 50%, and we have the 25% level. All of these get created. Very often, with Wicks in particular, you could almost void this higher part, but they're all here. And also just the entry to the wick as well is also a point that you could look at, right? A lot of people look at these wicks and they say, oh, it's only the midpoint. No, the fuck it's not. It's the entire wick, because we treat the entire wick just as if it was a fair value gap. Okay, so in this particular example of price action, you see price comes down into the midpoint, and then on this candle, we return right to the high end of this wick, and we continue off. Now, I said I would come back to this piece of price action, and that's because imagine you have something that looks like this, right? Let's imagine you have your high time frame level here. We're actually going to leave this on the chart for later as well. Well, let's say you have your high time frame level. This is probably a little bit more accurate. Let's say you have your high time frame level here, okay? In a case like this, you do have a big wick on top, but price is likely, especially if you close back underneath your high time frame level here, you're very likely to not reach the midpoint because you have your high time frame level. So this is something we'll talk about more in the entries video, but just as a kind of a precursor, if you were considering, for example, shorting the midpoint of this wick, because this meets all the criteria, right? It's bigger than surrounding candles. The wick is bigger than surrounding candles. It trades into a high time frame level. Potentially it's coming off of a liquidity sweep, which is also another quote unquote requirement or a confluence that could add a lot of probability to these wicks that you play. But if you close back underneath the high time frame level, very likely you'll just retest that high time frame level if the wick went all the way through it instead of going to the midpoint. Sometimes it will go to the midpoint, but if you're thinking about entering off of something like this, I'd rather just take the high time frame level to kind of ensure that I'm actually in the trade, if that makes sense. All right, so let's remove this just for sake of demonstration. We have everything that happened down here. This wick held, we pushed up, and then the same thing happened, right? We have this push. This is a giant wick, right? And this wick is substantially bigger than anything in surrounding price action, right? That makes sense. And now what you'll notice with this one is we did not trade into a high time frame level. So you could kind of classify wicks into two categories. In the second category, does not need the high time frame level. So you have one category, which is when you're at the bottom of moves, and then you kind of have another category of wicks, which I would classify as like the quote unquote breakout wicks, if you will, where you've already created kind of a bottom. You think direction's up in this particular example. You've created a low, and this quote unquote breakout wick is some sort of high that you create internally that you break into a new high. And this wick can be used without a high time frame level. This one I would recommend using a high time frame level like as a requirement, but something like this where it's more of a breakout, like price trades up out of the range and you're just looking to continue a direction, you could use this without a high time frame level, and the only requirement is that it's a big wick, right? So you take this, notice how you close above the wick, right? They don't get activated. It's just like a fair value gap, right? So if you're treating this as a fair value gap, imagine you were treating this as a bearish fair value gap at this point. It doesn't turn inversion. It doesn't turn inversion until you close over it. Okay, so really take that fair value gap thing to heart. When I say treat it as a fair value gap, I mean treat it as a fair value gap. So just like this would be a bullish fair value gap, now that you're getting over this, in the moment this would be bearish, right? But the second you close over it, this quote unquote wick or fair value gap, don't call these fair value gaps. They're not fair value gaps, they're wicks, but we treat them like fair value gaps in the same way. The second you close over the high of this can be used as a quote unquote inversion fair value gap or an inversion wick, right? So you close over top of it, and then price comes back down into the midpoint. okay, before it takes off. And oftentimes you'll see me take entries like this a lot. Like if I fail to get in here or I want a little bit more confirmation, you'll see me take entries like this a lot. When we get into the entries video, you'll see how I place my stops and shit like that for positions like this, right? So this is one example, right? And in this example, we talked about the low, right? And how we could use this with the high time frame level. This is at the low of a move. This is more like the breakout part of a move where you're expecting an aggressive continuation or an aggressive run. And that's how you could use inversion gaps or inversion wicks to kind of help on breakouts, if that makes sense. So price continues. Price falls, falls down. We create this fair value gap, and then we create this wick here. So this is an important part of this video because this is kind of an edge case that needs to be talked about because it's important, right? Notice how you have this fair value gap. So it should be going without saying. You need to know what fair value gaps are if you want to use this video effectively. Notice how we had this fair value gap right off the rip. And then notice how this wick pushes all the way through the fair value gap and then closes underneath the fair value gap, right? This candle's wick does. At the moment that this happens, if this be a bullish fair value gap or in this case a bearish one, this wick here is going to take over the role of this fair value gap. Okay, so what does that mean is you drag this aside. Oh my gosh, it turned inversion, right? It closed outside the high end of it, and then it just stops. Why? Because you never actually closed above this wick, right? And that's what I'm saying, where if you have a configuration of candles like this, where the wick completely encapsulates the fair value gap, you can more or less change that fair value gap to the wick. And now you're using the wick instead of the fair value gap, okay? Hopefully that makes sense. So price tries to push, it can't close that wick. So what does that mean? It's probably going to go test the lows. It tests the lows. Now let's imagine again, just for sake, let's imagine there's some sort of, I don't know, high time frame level down here or something, right? If you're still bullish, this becomes a fine setup where you have a liquidity sweep, you have a high time frame level, some form of internal confirmation. In this case, you don't close this fair value gap, you create a big wick. Something like the midpoint of this wick would be valid. And this wick to look at as a fair value gap would also be valid, like a bullish fair value gap. Okay. And by the way, sometimes you're going to notice that the market's using fair value gaps way more, and sometimes you're going to notice that the market's using wicks way more. So both of these things are useful, but every once in a while you'll notice how the market's using one or the other more often than the other one. So then price pushes. And remember, we still have this wick here, which is, in this case, the fair value gap, because exactly what we talked about back here, right? So in this particular example, the second we close above this, what can this be used as? Inversion. And you see how price, we close above the wick here. We close above it. We trade back down into the midpoint, and price rallies, okay? So this has talked about a lot so far. We're going to talk about more, don't worry, but this has talked about a lot so far, right? Some examples when you replace fair value gaps with wicks, some examples of what you're actually looking for in wicks and inside of big wicks, etc. And one more thought here, by the way, is if you're at all-time highs or all-time lows, let's imagine this was a push into all-time highs and you don't have a high time frame level up here. Well, in this particular case, because you don't have a high time frame level up here, you can just use all the levels in this wick. Like if this was all-time highs, you could just still use the levels in this wick. And by the way, you don't necessarily need a high time frame level to use the levels in a wick, right? So what do I mean by this? Let's say you don't have a high time frame level up here, and you create something that looks like this, right? Let's say you don't have a high time frame level for this lower wick, like you have nothing right here that tested into this. You could still use the levels in this wick on a lower time frame to kind of watch price see if you could degrade through that. Like this wick is still there, right? These requirements and these things that I'm kind of giving to you, saying it needs to test in a high time frame level, it needs to do this, doesn't mean that everything else doesn't exist. They still exist. It just means it's less probable to hold. But something being unprobable to hold is sometimes just as useful, because you could sit there and you could watch the degradation of that level on a lower time frame. So if that doesn't make any sense to you, what I just said, it will one day. It will one day as you get better and your intuition gets better and you can start to see these things a lot clearer. But what I just said is very powerful. If you get it, you get it. If you don't, you don't. Right? I can't explain it any better. So cool. You trade in this fair value gap. You replace this fair value gap with this wick. Trade down in the midpoint of this wick. Let's imagine. Okay, I know we're doing a lot of imagining, but let's imagine we have this high time frame level here. Okay, and we just tested into this high time frame level. You see it, right? We broke above it. We broke above this whole candle. We traded into the wick down here, the midpoint of the wick. We got above the high time frame level again. We traded down into the high time frame level. Now, if you look to the left here, we have this candle's wick. This candle's wick is bigger than previous wicks, but it does not trade into a high time frame level. But this candle's wick is very similar to this one, where it's more of a breakout wick. Okay, and we could draw this way, and the second price trades above it, we can make an assumption where if price holds inside of this wick, then we don't need to revisit the high time frame level. And in fact, my last two trades were based off of this. Depending on when you're watching this video, that means nothing, because my last two trades in a year are not going to be based off of this. But my last two trades as of 6/23/2024 were based off of this. So you break above this, we hold inside. So holding inside of this and holding inside this quote-unquote breakout wick is almost representative of you not needing to go retest the high time frame level down here. Hopefully that makes sense. Cool. We push up. Let's imagine this was all-time highs. ATH, right? Well, that means we could use this wick just as is because it's bigger than previous candles and we don't have any high time frame levels to use. I wouldn't short something at all-time highs, but if it holds, it could give you some information. But yeah, I would never short at all-time highs. At least not right at all-time highs or anything like that. And now we get into this bit of price action where you have this giant wick up here that gets created and we don't trade into it. And then what happens? Well, we break below this low. Okay, so now this wick that was used to hold us up before, well, it just turned inversion, right? Just like we just spoke about, it just turned inversion, right? So let's imagine you have something like this and this wick just turned inversion now, okay? Because you closed it. So on this candle, you closed it, this turns inversion just like a fair value gap would. This now turns into a quote unquote inversion wick, right? So any push back up into it, push into it, and the high time frame level in this case, but even if you didn't have the high time frame level, push into it, these can be used as quote unquote that inversion wick. And this is going to be the most aggressive way for price to hold, right? Especially like if you're in a move like this and you only come back up into the low and get rejected off that low, that could almost help you to anticipate very aggressive price action going forward. Versus if you were to pull up into the higher bits of the range up here, well, you're probably not going to have as much of aggressive price action running down. Now, you might, of course, you don't know what the market's going to do, but really rejecting off the first test of this range, and oftentimes it's going to be a big wick like this, can indicate potential, like a lot more aggression coming through. And this could be extremely quick, right? Like you might see something like this where this closes here from like one tick, and it trades up just a little bit into the like that wick, and then it just dies off, and it never comes back up into that, right? It doesn't need to sit there for a while. This could just go right off of the immediate test of that. So this kind of goes over pretty much everything to do with wicks. Like I said, there will be an entries video that goes over how to enter wicks and where stop loss placements are, because it's a little bit different than fair value gaps. But this is how I look at wicks. This is most of the cases. If I missed one, ask a question about it. I think I covered everything. I kind of crafted this price action to try to cover every single case and every single scenario. From when to use high time frame levels, when to not, when it takes over fair value gaps, these kind of more breakout wicks, and if we're at all-time highs, etc. Just basic types of wicks that go into high time frame levels that you could use, how to filter them out so that you're not looking at every single wick on the chart. I think I went over most things that should be helpful. If I missed the scenario that you're thinking of, go ahead and ask me about it. But this is Wicks. All right, so volume imbalances and overlaps. These are, again, some of the more fundamental types of levels that I use in my day-to-day trading. And these are very, very similar to fair value gaps, except they're a little bit different. So imagine a case like this where maybe you don't have any fair value gaps, right? Maybe you don't have any fair value gaps. There's no fair value gap here because no wicks leave a gap, but you do have a gap between candle bodies. So this is caused when a candle closes and then the candle and then the very next candle gaps up or down, which we'll show bearish examples as well in a minute. And it leaves this gap between the candle bodies, right? Normally, if this was a normal perfect market, it would have just opened like this. There would be no, in this case, volume imbalance. However, when a candle opens like this, and imagine you didn't have wicks, there would be a clear gap between the bodies. So that's an easy way to spot volume imbalances. Just imagine you didn't have wicks, and the gap between the candle bodies, that's what we call a volume imbalance. And all it is you could treat it just like a fair value gap, right? And it's gonna work just like a fair value gap. It's gonna do everything just like a fair value gap, and that's pretty much it. That's what a volume imbalance is. And it even could go inversion like a fair value gap, right? So if you fall down and you close underneath it, you can now treat this as a inversion volume imbalance. Everything goes inversion. Even order blocks can be inversion, which I don't even know if I talk about in this course, but they can. Every single thing can go inversion, right? So that is what a volume imbalance looks like on the bullish side. And then on the bearish side of things, it's very similar, right? Imagine we didn't have wicks on any candles. We would have a very clear gap between the candle bodies right here. And this is what produces a volume imbalance, as you can see right here. And if price was to close over that volume imbalance, we would also have this as an inversion volume imbalance that could hold us up, okay? And also, you notice in this example, there's a fair value gap here, but then there's also a volume imbalance here. So whenever you have a volume imbalance connected to a fair value gap, what you're going to do, and we talked about this a little bit in the fair value gap video, is you're going to drag a fib from where you would mark it if you were to include the volume imbalance. And then if neither of these wicks intersect that midpoint, then you're going to include the volume imbalance and the fair value gap. So you're going to draw it just like this, okay? So again, you're going to mark a fib as if you were going to mark it like this, and then notice none of the wicks intersect that halfway point. So with that being said, you would treat that entire range as just a fair value gap. So I wouldn't consider this really a volume imbalance. I would consider this a fair value gap. And I would consider this a more true volume imbalance because there is no fair value gap connected to it. So hopefully that makes sense. We could go to chart examples as well. I'll do a couple chart examples in this video, but overlaps and volume imbalances are pretty simple and quite, I guess, a small part. So I'm mostly just going to show you how to mark them. Alrighty, and overlap levels are exactly the same, except they're a little bit different, right? Instead of there being a gap between bodies, there's a overlap of candle bodies, okay? And then we could take that overlap, and that's going to be our level. As of anything, they can turn inversion as well. We're going to take that overlap of candle bodies. That's going to be our level. And these are called overlaps. And the ones where there's a gap between the candle bodies are called volume imbalances. So let's go to the chart, and I'll show you a couple examples for each one. And then we'll move on to the next part of technical analysis here. All right, so here's an example of a overlap level. Or not an overlap level, my apologies, a volume imbalance. And again, imagine if you were to just take wicks off the chart. All you're looking for when you're looking at volume imbalances is you're looking for this actual gap in candle bodies, okay? So the gap that gets created in candle bodies right there if there was no Wicks. Obviously, you're going to trade with Wicks. That's what you call a volume imbalance. And here's a bullish example, right? They're everywhere. And a lot of times they don't even get traded into, right? There's a volume imbalance that doesn't get traded into. Here's an overlap level. Here's an overlap level that does get traded into. Why is that an overlap level? Because the bodies overlap. These things are everywhere, okay? And sometimes, especially on small time frames, you just blow right through them, and that's okay. Again, we're using most of these things on a very high time frame, and at the end of this course, you're going to see exactly how I go about marking high time frame levels, which is really where the real power of all this technical analysis comes from. I repeat, and this is a ongoing thing I've been repeating, do not go and mark only 1 minute levels. Don't do it. You are screwing yourself over big time. The edge that I have comes from the high time frame levels. Okay, if you're not using the high time frame levels, you are not doing it correctly, in my view of things. All right, so that's overlaps and volume imbalances. There's a volume imbalance right there. There's an overlap level right there. There's overlaps everywhere. There's like one tick overlaps everywhere. There's volume imbalances everywhere. The reason why it's a little bit different on a high time frame is because of weekly and daily gaps. So if it's on anything daily and weekly chart, don't treat them as volume balances and overlaps right off the rip, because they could be something else, which you're going to learn in this course, in this crash course, as well. And these things also show up on very high time frames, right? It's not just a low time frame thing, albeit they are much rarer on high time frames. So, for example, you see this volume imbalance here. Well, this is connected to a fair value gap. So we're going to treat this whole thing as like it's a fair value gap, okay? It's pretty rare to find a volume imbalance that's not connected. Here's a overlap level that was not connected. Here we go. We had a overlap level that was not connected to any sort of fair value gap, and price comes down, trades into it. Just like we had a volume imbalance right here in a fair value gap, but it went down into here. It also went down into the order block. So yeah, it's kind of hard to find an example of these turning inversion on a high time frame, but they do. Trust me, they do. It doesn't happen all too often, but it does happen. And that's more or less what a volume imbalance and a overlap are. That's what you're looking for. Remember, the key here is if you took wicks off your chart, how would the candles look? If the candle bodies overlap, then you have a overlap. If the candle bodies gap, then you have a volume imbalance. And that is a very easy, very simple way of distinguishing the two.
So all a order block is, in this case in a bullish context, we'll look at a bearish context in a moment. All an order block is the lowest close down candle at the bottom of a range when price is bullish. And the second that price trades above the high of the lowest close down candle in a range, that is when the order block gets gained. Now there's some edge cases to this, which we'll discuss. This is only the absolute basics of what an order block is in a bullish context. Now let's say price opened and traded down into this bullish order block. That is when you would look for a long. That's how you get an entry on something like a bullish order block, okay? So price trades down into the bullish order block, and that is a long. Now, like I said, there is some edge cases, so let's look at those now. So let's take an example like this, where you have a range that looks like this. The bullish order block in this case, a lot of people would mark as this particular candle, or this level, or this level. This is not the case because of what I just said. The order block is the lowest close down candle in a bullish context. So you're actually going to be looking at this candle. And in the future, and a little bit later in this video, you're going to learn about the different levels inside of an order block, like the mean threshold, and how you could hold the mean threshold before the order block gains to let you in on if it's going to gain or not. Now that's a little bit too advanced for right now, but in this particular case, this would be the order block level. This candle would be the bullish order block, not these candles. These candles are nothing. These candles are not order blocks, and they're not anything. They're just candles. And price could trade into that bullish order block like this. Let's say price opens, trades down into the high. That is the bullish order block inside of this range. Why? Because it's the lowest close down candle in a range on the bottom. Okay, price could come back up. Now, this is the bullish order block. Let's take a look at a bearish order block. So this would be a bearish order block, okay? It's the highest close up candle at the top of the range. And the bearish order block gets gained, or it becomes active, when you trade through the low of the candle. Not when you trade through this, not when you close through it. The second that you trade through it, it becomes gained. So that means even in the same candle, if it traded up into it, that is testing into the bearish order block. And it can expand down. But typically, what you'll see is something more so like this, where you will see price later on trade into that bearish order block, okay? And then the edge case example, just like it was down here, is the same exact thing with bearish order blocks as well. So if the example looked a little bit more like this, this would be the bullish order block. Why? A lot of people might say it's this particular candle, but it's not. This candle is nothing. And the reason why is because this is the highest close up candle in the top of the range. Just like before, this is the lowest close down candle in the bottom of the range. That makes this the order block, and that makes these candles nothing. Just like how on top, this is the order block because it's the highest close up candle at the top of the range. This candle is nothing, okay? So that's what a order block is. Now let's get into the particular levels that exist inside of order blocks. So inside of an order block, you have a couple of different levels. Let's take this one at the bottom of the chart here as an example. There's 3 different levels inside of any given order block. For a bullish order block, you have the high, which just represents the most extreme part of the order block. So this entire candle is an order block, but there's particular levels that we look for, and one of them is the exact high, okay? This should be a sensitive area. If you're bullish and the market is moving up, price should use this area as sensitivity. You also have the opening price of the candle, right? Price could come down to the opening price and also hold off of it. Typically, you're going to be using the opening price when the wick is a lot shorter. And then there's also one more, and that's the exact middle point of the entire candle right here. So you could use a Fibonacci tool like this. These are my settings if you want to know what they are. Drag it from the high end of the candle to the low of the exact candle and take the midpoint exactly. And that is what's known as the mean threshold of this bullish order block. Now, we'll talk later about the implications of each of these levels and when you would use one versus the other, but currently and right now, just know that all 3 of these levels inside of a bullish order block are going to be sensitive points, just like for bearish order blocks, where you have the low, the opening price, and the mean threshold. And the market could have tested the opening price, it could have tested up into the mean threshold, it could have done anything like that. Now let's talk about when you would remove an order block from your chart and no longer use it. And by the way, if you're a little bit confused, don't worry, there will be a plenty of actual chart examples in this video as well. This is just a very general, broad theoretical overview so that you can follow the rest of this video without being confused. So let's take an example like this, which is a bit of an edge case here, where price has gone all the way through this order block, even wicked above the high of it right here, right? And then we came all the way back down. We closed over all these levels. A lot of people would remove this as the order block. But for me, this is still the order block in the range. Why? Because it's still the highest up close candle in the particular range. So when price leaves this range again and comes back, this to me is still the active order block in the market, okay? The only time that you would remove an order block level is not when it's tested, but when a new up candle closes above it. So if instead the market looked a little more something like this, at this point, this order block would no longer be valid because it has a close higher than it. You see how this candle closed higher than it? At that point, that's when you would remove an order block from your chart. Not when it wicks above it, not when it opens above it like this. Like if there's a gap and the market opens above an order block, you don't remove it then. It's when a new up close candle closes above it, and vice versa for a down close candle, okay? You would not remove this bullish order block from your chart until you had a bearish candle close beneath it. And the second a candle closes beneath it, beneath the body of it, that is when you can now remove this as the order block, and this is the new potential order block in the range. Okay, so With that being said, I think it's about time we get on the charts, see some examples, and talk about the different levels inside of an order block and when to use things like the high, the open, and the mean threshold. And also, how to know if an order block is going to be more high probability than an other order block, and when to use them in general. All right, here is an example of a bullish order block in the market. This is going to be a very typical example, and trust me, later on in this video, all of the stuff that we're talking about right now may seem very basic, and it's like people have already talked about this and whatnot. Later on in this video, we will be talking about things that nobody talks about and things that make these much more powerful than just normal support and resistance or normal anything. Later in this video, you're going to see how I really use order blocks and how I use them for predictive power and bias purposes on an intraday and long-term basis. But we have to go through the basics before we could get through the advanced stuff. And the basics is just identifying order blocks in general. So in this particular range of price, the market is moving up. That's the first key. You need a bullish market for bullish order blocks to work, of course. Now, this candle right here, price falls down. This is the lowest closed candle in this particular range of price, right? So when the market trades above what? When the market trades above the high of this candle is when this order block is gained as a level. So at that very moment, when the market trades above the high, and again, later in this video, we'll show you how to know if an order block is going to gain or not, which is when these become very powerful. In theory and technically, for the levels in an order block to become active, you first need to trade above the high. So boom. The second you trade above the high, every level inside of this order block becomes active. What does that mean? Well, you also have the open that's active now, but you also have the mean threshold that's active now as an order block level. So there you go. The second that the price trades above this high, all these levels are active. And notice how in this particular case, price went above that high and traded directly down into the mean threshold, down to the mean threshold again, down to the mean threshold once again. And again, later on in the video, we'll talk about what it means when price trades into the mean threshold versus when it doesn't, etc. But this is the first example of an order block that I was going to show you. And the next example just so happens to be in, for example, this range here, where price pushes down, creates the lowest down close candle in this swing range. That's what I mean when I say range. In this swing low, this is the lowest down close candle. Now you would also have a candle right here, which you could class as an order block as well, because this is the lowest close in that particular range. This, however, is something different. This is a different part of TA that I will talk about in the future. Now, in this particular swing low right here, this is the lowest down close candle. So the second that price trades above the high of it, all the levels in the order block become active. And you see that price trades above the high and trades back down into where? The open, and it could have also traded down into the mean threshold. And again, later in the video, we'll talk about how to know if a order block is going to gain or it's not going to gain. Let's show another example here. So in this case, in the swing low range here, price, first off, pushes down. This is the lowest down close candle in this particular range that creates the order block right here. Okay, price trades up above the high of that order block. Now all the levels inside of it are activated. So even here, when we trade above it and then trade back down, this price movement back down is testing into this order block. And you also activate all the other levels. So that includes the mean threshold, which later on in the market, you trade right to where? The mean threshold of that order block. And you also create a new one in this range right here. So what is the order block in this swing range here? Well, some people might say it's this candle. It's not. Some people might say it's this candle. This is the candle it is. Why? And it's definitely not this, right? Going into the future, this is not the order block. And in fact, here you wouldn't even be looking for an order block to be used at all. But that's for a later time. In this particular swing range here, this candle right here, October 4th, is the order block because this is the lowest down close candle in the range and it has the biggest body. If both of the candles are at the same exact close, let's say you have two down close candles that are closing at the same exact price, you're going to use the one with the bigger body. In this particular case, this is the lowest down close candle and the biggest body candle. So the second that price trades above the high of it right here, that's when any price movement back down into it is considered a test into the order block. So the second you trade above that high, that's when you activate things like the open and the mean threshold. And as you can see in this case, you get real close to the mean threshold. You just miss it by a tiny bit, and that's actually good. And we'll talk about that again later in the video, but the mean threshold is called a threshold for a reason, and very often you don't even want price to test into it. But the second it trades above the high, that's now when any retracements back into this range of price, that's when it becomes active. That is when it becomes an active order block. Let's take a look at a handful more bullish examples, and then we'll look at some bearish examples, and then we'll start to dissect the differences between the open, the high, and the mean threshold of a particular order block. Now I'm taking you over to another market. This is crude oil. This also works on every market. You could be trading crypto, you could be trading forex, you could be trading index futures, you could be trading commodities, you could be trading anything, the traditional stock market, anything, and this will work in all markets. Now, this is a great example because this showcases the importance of knowing what is the correct order block. A lot of people would instinctively jump to this one. This is completely wrong. This is not the order block. This is not the order block. This is not the order block. This is not an order block. None of these are the order blocks because they're all encompassed by this large down candle. And this large down candle in this swing is the lowest close price in the range. This down candle is the order block. So when you have this, the second that price trades above it, that's when it becomes active. And notice that the second you trade above it, price comes back down, trades into it, trades into it, trades into it, trades into it, but you also activate the other level. So the second price trades above it, you also activate the open, and you would have also activated the mean threshold, which price did not get down into. But notice how, because now that we have the right order block, this is being respected a lot more, right? We hold it right when we get above it, hold it again here, hold it again here. We dip lower, and where do we go to? To the tick, we go to the open of the correct order block. We get above it, we hold the high again, and this is being used to accumulate price action. And this does not get removed from the chart until price would close beneath this candle. This could stay on here forever. Price could come back and go up and then come all the way back here, and this would still be on the chart even all the way back here until a candle closed beneath this particular point. Okay, this candle is nothing. This is not an order block. This is not in anything. This is the order block because it's the lowest close candle in the particular range. Okay, let's look at one more bullish example before we hop into looking at some bearish examples, and then again we'll start looking into the differences between the levels, when to use each one, and some of the more powerful ways you can use order blocks in your trading. All right, so this example is slightly less straightforward, but if you follow the principles, it should be just about as straightforward as the other ones. So what is the order block in this range? The lowest closed down close candle is the bullish order block. Is this candle closed low? Yes, it does, but this one closes lower. So this is the order block level inside of the range. So the second that price trades above this high, all the levels inside of this order block get activated. And yes, you can make the argument that price trades down into here more accurately, but at the end of the day, this is the correct order block. And the only reason something like this even holds is because it's within the correct order block. So this would be the correct order block in this particular range. Just like up here, right? Just like up here, this is the lowest close candle in the range. So the second that price trades above this high, this is now the correct order block. And any movements back down into it is testing into that order block before price runs higher. Just like up here, this is the correct order block because this is the lowest close candle in the range. And you start to notice now they're starting to get degraded. Eventually they roll over. This trades down to something lower, which is actually a higher time frame piece. We'll talk about time frame analysis and differences later in this video. But for the most part, this should all be pretty straightforward. And if you know about order blocks, this should all be along the lines of what you already know. Now, first, let's get into a handful of bearish examples. We're not going to be doing as many bearish examples as bullish examples because really it's just flipped on its head, so I don't want to waste your time. However, after we get through the bearish examples, we are going to start talking about some of the unique ways that I use order blocks in a much more powerful way than is normally utilized. Let's get into those bearish examples, and then let's get into the more fun things. So here is a bearish example of an order block. Okay, price has shown a willingness to start moving down. That's important because when price is moving up, bearish order blocks do not work. Just like when price is moving down, bullish order blocks do not work. A directional bias is absolutely necessary for these to have any sort of probability and any sort of predictive power in the marketplace. And if you want a video on directional bias, go ahead and drop in the comments if you want that, and maybe one day I will make that, because my ability to have a long-term directional bias is, bar none, one of the best I've ever seen. I'll be right on a directional bias for hundreds of days straight, only to be wrong for a couple days in a row when the trend is switching. But I'm very good at a directional bias, and if that's a video that you guys are interested in the future, tell me. But these things only work with a directional bias in mind. So in this example, the order block, the bearish order block in this range is this particular candle right here, because there is two candles, and some people would say, no, it's this one. This is the order block. Nope, this is the order block. This is the order block because this is where the highest up close candle is in the range. This one closes here. This one closes higher. So this is the particular order block. And the second that price trades down below the low of that candle is when all the levels inside of it are activated, and also the mean threshold, which I'm not going to mark, but would line up right about here. And you'll start to notice that the mean threshold sometimes gets held before the order block is gained, and that is a prelude to what we're going to be talking about later in the video. Now, as you can see, price trades down, gains the order block, comes back up, tests into it, and that leads to a massive sell-off in the price. Let's look at a few more bearish examples. So this is euro dollar on a monthly chart. Yes, a big time frame, but it's just an example here. Back in 2008 and 2009, we had this order block get developed in the market. So what's so special about this? Notice how this is the highest candle in the range. We gain it when we trade through the low, right? So we're not looking at this. If you thought that this was the order block, it never got traded into. Why? Because this is not an order block. This is actually nothing. Okay, this candle is quite literally nothing. This is literally nothing. Okay, this is not an order block. This is not anything. This is the order block because it's the highest closed up candle in the range. Mark the low of it, and this was created in 2008, and in 2009, Euro USD came right up into it, traded up into it, and sold off in a big way, leaving behind another bearish order block, which got gained when you traded beneath the low of it, and price ultimately came right up into the mean threshold of this particular order block, leaving behind another order block in this range in 2011, which gets gained when you trade through the low, which in 2011 traded back up into it, back up into here, and pushed. And a lot of times you'll see this kind of trailing effect with order blocks being created over and over and over again, right? But this is really the big example that I wanted to show here. Now let's get one more kind of weird example, and then we'll move on to the more interesting topics in this particular video. All right, let's look at this. And I'm switching markets a lot because I want you to get a gist that this is working in every market at all times. So this is literally soybeans, dude. Who trades soybeans? I don't know. There's somebody that trades soybeans futures. Actually, I'm kind of interested in soybeans. I think it's a nice chart. Anyways, totally off topic. But we have this range right here, which creates an order block. You should be able to see that just fine. Price trades into it in 1981 and then trades back into it in 1988, 7 years later, right? And price gets respected here, and it leaves behind another order block. So pop quiz, what is the order block in this particular range? It's this candle here. And when price trades right beneath the low of this candle is when it gets activated. So you might look at this and say, oh, yes, price traded up into it here and blah, blah, blah. But even within this range, it traded up into it. Look closely. Price gains the order block in July of 1988. This is September of 1988. It gains in July. So that means all the levels become activated. In the next 2 months later, we trade up into the mean threshold and sell off. We get below the order block, and we hold it again in 1989. And then that leads to a massive sell-off ultimately, eventually it gets ripped through, as all things do when the trend changes. But for these years and for these moments in time, this was the active order block at the moment, and it led to a major sell-off in this market. Just like here, this is the order block in this range, right? We could use this example right now. It gets gained when you trade through the low here. It gets gained when you trade through the low right there, and all the levels get activated. So that means everything, even the mean threshold, which we just missed trading up into, which we'll talk about very soon. So that's it for the bearish examples of order blocks. And part of the reason we use order blocks is not to look for a perfect test. Like something like this might be like, well, this thing didn't test perfectly. How do you get an entry on this? Part of the reason we use order blocks is not to look for a perfect test, but to have some sort of confirmation of bias. So in this particular example, yes, we gain the order block. That could give you confirmation that, hey, we might be running lower into the market. So that could let you in on, hey, if I could get short setups above the order block low, then these are going to be much higher probable shorts because I know that I'm shorting within the range of this order block level that just got gained. So keep that in mind when you're using these levels, is that we're not looking for perfect tests. Nothing is ever considered tested. They stay on your chart forever, right? Until they get closed. Like this order block here will stay on the chart until it gets closed. I'll let you in on exactly when it does get closed. This is the close of the candle. This order block goes away. This order block is no longer valid. Look at this. It gets tested once in 1981. It gets tested twice in 1988. It gets tested 3 times in 1997. It gets tested 4 times in 2002. And then you start to see the breaking of it. And eventually when price closes above the close of the order block, the highest close in this range, it closes above, it then comes back down, retests it, which we'll also talk about, and fires and rockets up for a very long time to come. And you'll see that pattern a lot where an order block gets used up a bunch, and then it gets broken, and then it gets retested, and then it goes. But that is the very, very, very basics of order blocks. Now you know how to define them on a chart, how to look at them. The next thing we're going to get into is the differences between the lower the high, the open, and then the mean threshold. When to use them, what does the mean threshold mean, and when one is going to get tested over the other. Then we're going to get into what makes me a little bit different with order blocks and how I use them in a very unique way that has much more power, in my opinion. Okay, so let's get into it. Alrighty, so as we've already spoke about, there is 3 levels within each particular order block. In this case, we're only going to be using bullish examples and just flip it on its head for bearish order blocks. Okay, there's the high, there's the open, and then there's the mean threshold. And again, the mean threshold is just the exact midpoint from the highest point of the candle to the lowest point of the candle. That is the mean threshold of the order block. So the high and the open are very easy ones, and we'll talk about them right now. And what I'm going to describe here is a very simple rundown of them. If you want a little bit more of a detailed rundown and really how to know when to use each level, this is just going to be a very basic run through. You could go ahead and join my Discord down in the description, where I have plenty of videos where I walk through particular trades that I take, and I have a lot more educational content, hundreds of hours of educational content, and hundreds of videos of educational content. Now, in this particular example, the high and the open are very easy. Typically, price is going to want to trade to the open of the order block if the wick is very short. And then more often than not, if the wick of an order block is very long like this, price will tend to just come down into the high or slightly pierce the high before moving up. But usually if the wick is very short, it'll go to the open. And usually if the wick is very long, it'll just suffice to trade to the high. Now, obviously if the wick is very short, you might as well just take the high, because why would you risk not being in a trade just because it's a couple ticks away? Now, obviously other reasons that I'm not going to get into here include things like maybe the high of this, maybe the wick coincides with another high time frame level or a fair value gap or an inversion fair value gap or another wick level or something of that nature. and maybe the open doesn't coincide with anything, then if there's more confluence for one of these levels, you'd use one of them over the other. But really, another part of it is just risk management. When you trade on an order block, your stop loss goes right below the order block level, right? So if I get long on the high of the order block, my stop loss goes here. If I get long on the open of the order block, my stop loss goes here. So really, at the end of the day, another argument for this could be if you want your risk reward to be a little bit higher and have a little bit of a tighter stop, you could go for the open, but you're risking missing even entering the position. And if you want to just get in the position and you don't really care as much about the risk reward, you could just enter on the high, and the high is going to be much more likely to get you in a trade versus the open is going to potentially offer a tighter stop and bigger risk reward. Where this gets interesting is when we start talking about the mean threshold. So again, the mean threshold is the exact middle of the candle, highest high to lowest low. This example, this level right here, 17,622.5, is the mean threshold of this candle. And what the mean threshold represents is a point in the order block a candle should not violate by a body closing. So what do I mean by that? All right, so for this example, I removed the high end of this order block and I removed the open of the order block, and I just left the mean threshold here. So in general, the mean threshold is another point of sensitivity, but it should be the point in the order block for the order block to succeed where you don't see the mean threshold violated by a candle body close. In this particular example, you wicked through it and that's totally fine. Wicking into the mean threshold is permitted. But when things get a little bit, spicy, or when things get a little bit wrong, or how you can anticipate potentially an order block starting to fail, is if this would have closed beneath with a candle closure. If this closes beneath the mean threshold with a candle closure, that is typically, and not always, this is very important, you could close beneath the mean threshold and still have an order block work. But typically, if an order block gets its mean threshold closed, that is early indication that potentially this order block is failing. You are going to see many examples where the mean threshold closes and the order block still works. Again, on average though, and this game is a game of probabilities, if the mean threshold gets closed, the probabilities indicate that potentially that order block is going to fail. And if you're in a position, maybe you should get out. Now, everything that we've talked about up until this point is very normal and very basic. But the mean threshold of an order block holds a lot more, not magic. The mean threshold of an order block holds a lot more analytical power than most people ever realize. And what I'm about to talk about is something I've never seen anybody talk about. And what I'm about to talk about is a great way to start utilizing order blocks in order to have a better understanding of bias intraday and very, very long term. What I'm about to talk about is the very introduction of a concept that I coined called projected defined ranges. Now, this is a extremely light introduction to projected defined ranges. And if you want to learn more about projected defined ranges in the future, you are going to have to join my Discord down in the description. This is going to be a very simple introduction, and it's only going to be showcasing order blocks. Projected defined ranges go much further and much deeper and are much more accurate than most things ever will be. So now that you know the basics about order blocks, you know the terminology, you know how to identify them, you know how to see them on a chart, let's get into what I believe to be one of the more powerful use cases of order blocks and how you can understand if they're going to gain or not gain, and how you could be entered in an order block before the order block gets gained in order to participate in the first move. So let's get right into that part of the video. So, projected defined ranges and order blocks. You finally made it. The point of the video where order blocks go from just something that you enter on to something that could help inform you with long-term directional biases that produce major moves and massive directional price swings. What is a PDR, or a projected defined range? Now, I gave you a hint earlier in the video that when it comes to order blocks, part of projected defined ranges has to do with the mean threshold of a order block. All right, I promise you we're going to get onto the charts and look at real examples in a moment, but you must understand some theory before we do. Now, what I have set up here is an example that's going to show you how to use projected defined ranges with order blocks. Projected defined ranges with order blocks are usually only very useful when you have a large time frame order block that you want to know if it's going to gain or not. So in this case, let's imagine we have this weekly down candle, okay, that we think could turn into an order block. Right now, it's not a gained order block because we would need to trade through the high. But this could be a large range, right? If this is a weekly, from here all the way to the high is a massive range of price. That could be hundreds and hundreds of points. Or if you're trading forex, hundreds and hundreds of pips. Or if you're trading crypto, thousands of dollars of price. How can we use projected defined ranges to understand if price is going to move from here all the way up to here? And how can we capitalize on that? By taking a trade into the gaining of an order block and beyond. So the mean threshold of an order block has a lot more, I guess you could say, uses than what first meets the eye. Before an order block is gained, you can utilize the mean threshold of the ungained order block to predict if the order block is actually going to gain. What the fuck do I even mean? Let me show you. Let's say price in this weekly candle trades up into this range and then comes down and sits around here for a while. What would that look like on a lower time frame? Well, that would look like this. Price would have traded up, got above the mean threshold of the ungained order block, and started to hold. This holding of the mean threshold of the ungained order block creates an accumulation phase that's target is to gain the high time frame order block. So in my projected defined range theory, this creates a point A with a projected range to go and gain this order block at point B. So now we have a range of price from A to B because holding the mean threshold on a lower time frame before it's actually gained indicates the willingness and the want for price to go and gain this. But that is not all. That's just where this gets started, right? Even this alone is hugely beneficial, and even this alone provides opportunities for a trading setup, and a trading setup that me myself partake in, which is, hey, if I see the mean threshold of a high time frame order block holding and it's accumulating and an entry setup gets found in here, which if you want me to do a video on particular entry setups, right, this is more ideas forming and how to utilize these concepts. If you want me to do a video on how to form entry ideas, go ahead and drop a comment down in the description. However, this creates a range of accumulation. If I could find an entry here, I know that price is potentially wanting to go gain the order block whose mean threshold it was accumulating off of before the order block got gained. But again, like I said, this is only the beginning, because the real power of projected defined ranges is when you have the projected defined range, because now we have a point A and a point B. So what I just talked about, although not commonly talked about, and in fact, I'm the only trader that I think talks about this, this alone is not projected defined ranges. This is not my theory. My theory is once you have two price points, if this level holds, we should go to this. Once you have an idea like that, you can now start to implement and utilize projected defined ranges in order to understand where price is going to stop and accumulate out for the second time. So what I mean by that is if you have this point A and a point B, you could draw a fib from point A to point B, and now you have the middle, right? This is the middle of the defined range that you have. Okay, the projected defined range is from point A to B. Okay, and now you have the middle of that. In theory, under the guise of projected defined ranges, this is where the actual accumulation will take place to bring you into point B. Please stick with me if this is confusing. We will look at a handful of examples on the chart in just a minute. Okay, but you have to understand the theory behind it first. So what I'm saying is that price will likely want to target this middle point, get above it, come down, and accumulate on this level before going to point B. So this is a second range of accumulation that it gives you. And this is actually my preferred place to play the projected defined range in an order block. Because when you're accumulating on here, it's not necessarily confirmed. Now, it's very likely that accumulation seen on the mean threshold before it's gained will lead to a gaining of the order block. But once you get above the projected defined range level, it becomes exponentially more probable that if you witness accumulation on the midpoint between point A and point B, that price will actually trend upwards and trade into point B to gain the actual order block level. And I personally like trading inside of here. Okay, so this is the theoretical view of how to use projected defined ranges with order blocks. And the first example I want to show you is a massive example that's allowed me to have the correct bias on NASDAQ for the last 130 days straight. So, as I said, projected defined ranges are very much applicable when you're utilizing high time frame levels, because those are what's going to give you the most range in order to play your idea off of. So the yearly chart on NASDAQ. Early in mid 2023, this was the yearly chart. And this down close candle was the order block that we were trying to gain. What do I mean by that? Well, if we would have traded above this high, then we now have a yearly order block that we've gained and can utilize to hold us up going into the future. If you're trying to follow along and you're on the NASDAQ chart, it is in Q1, okay, with B adjust turned on and set turned off. B adjust when you're trading futures should always be turned on. Exactly like what I said with projected defined ranges, you also have the mean threshold of this candle. So notice how when we drop down to a lower time frame, and this just so happens to be a daily, and go back to the yearly, for example, before this order block is gained, before it's gained, we came above the mean threshold of that potential order block and we held the mean threshold of it. So this sets into motion a point A and a point B. We now have a projected defined range in motion. We're expecting that from holding 14,408.50 right here, price should, in theory, trade all the way up to 17,575 and gain the yearly order block if projected defined ranges is correct, right? Holding the mean threshold before the order block is gained should onset a price move up into the gaining of that. Now, this is a very high time frame, isn't it? Now you can see the power, because this is a 21% move on index futures, or quite literally over like 3,100 ticks. This is or 3,100 points. This is a ridiculously large move. These are daily candles, okay? These are daily candles, and this is the type of move that we're predicting with projected defined ranges, which is my theory. So, what's next that I told you? Now that we have a point A and a point B, we could look for the midpoint of that. So 14,408.50, and this should be exact, to 499.75. There we go. It gives us this particular level, and usually with projected defined ranges, this is kind of a side note. I personally like making them single thick dash lines. Okay, if you ever see a single thick dash line on my screen, it's a projected defined range level. So this is tradable. Like if you get a long down here and you're aware of projected defined ranges, you understand that your target should be all the way up here at 17,499.75. Now, the first way that this gets confirmed is if price trades from point A to above the halfway point and then could come down, accumulate on here, and that should lead to a run into point B. So let's see what happens. Press play. Boom. Price gets above the midpoint between point A and point B. The next part of this is to see if there's a willingness to come back down inside of the midpoint, which would be that accumulation to take us to point B. This was the first stage of accumulation. this is going to be the second stage of accumulation for price to run into 17,499.75. Okay, and what does price do? It comes right back down into where? Right back down to that midpoint. So how this is so powerful is because now you should be pretty damn convicted that this yearly order block is going to go gain after this holds. So you could drop down on a lower time frame like this, and this is how you could start to use lower time frame order blocks to gain higher time frame order blocks. And this is a valid system and a valid strategy if you wanted it. We swept a bunch of liquidity, which I have a video about in my other I have a video about on my channel, right? We swept liquidity. Point A has already been onset, so we're already looking to point B. We traded down into the midpoint, which is that second stage of accumulation. This was the first. These are connected. Now this being hit should onset the run to 17,499.75, should it not? Okay, let's drop down to a lower time frame. This is the lowest candle in the swing low, which gives us our order block right here. So when price comes back down into that daily order block, we could be long with the understanding that the high time frame is already onset a move to 499. So we could enter this long with a take profit at 17,499. And this is the absolute power of projected defined ranges. A very simple concept, but an exceedingly powerful one nonetheless. Right. And we get this whole huge pullback. And the great thing is, even on this pullback, we could be pretty convicted that this is just a pullback. And if you were in my Discord, we were looking for longs right about here. And a longer term continuation to continue price higher because we knew that the projected defined range was in play. Okay. We could be convicted that there is a pullback and we could feel a lot more safe buying in this range, right? It could be this order block, it could be this fair value gap, it could be the higher inversion fair value gap on the monthly that's in play in this particular case. It could be the monthly media rebalance that's going on. But either way, it should be bringing us up into 74.99. Now, I want to mention right now, this is a very, very basic level of projected defined ranges. It goes much, much deeper than this, okay? And if you want to learn about it deeper than this, go ahead and join my Discord down in my description. It is a Patreon video, and it is on the Patreon. However, again, I have hundreds of videos there. I put a lot of work into it. That's why it's paid. I also want to paywall questions because I don't have all day. I can't answer questions from everybody. It's $30. I try to make it affordable. You get all the videos. So I'm giving this out for free, but if you want to learn more, because this concept, my concept, projected defined ranges, goes much deeper than this, you're gonna have to join the Patreon. Now, let's go over a handful more examples of projected defined ranges so that you can get the hang of this a little bit more. We'll go over one more bullish example, and then we'll go over a bearish example to end the video. All right, let's use this particular candle as an example, okay? So we're inside of a larger time frame projected defined range, and this is the daily chart. And let's say we were trading on the day of January 18th, 2024, okay? This candle just came down and traded into the lower portion of this wick, which we won't talk about, but for anybody curious, the level is this one right here. And on the day, okay, I don't like talking about things that are hindsight. That is not very much me. On the day we were looking at this level 2, I was looking at 16,690.25 to be low a day, and it was, okay? And then I was looking for this order block to be gained. Well, it's not an order block yet. No, it's not. But if this range creates a swing low here and price trades above, this will be an order block in the future, okay? So going into the next day, we could start to look at things like the mean threshold of, which is the exact halfway point, okay? And we could start to look at things at the high, right? So we drop down into a lower time frame and we could say, this is the start of the new day. And notice how price comes down right away to the mean threshold of the ungained order block. Early in the day, very early, this is Asia session, this could start to let you in and keen you in that, hey, price is going to very likely run for these highs and gain that daily order block going into the day today. So what can we start to do? Well, this gives us a projected defined range. It gives us a point A and it gives us a point B, right? The mean threshold of the ungained daily order block here is starting to hold. So that gives us a projected defined range of 16,835.75 to 16,982, right? Which is a massive move on index futures. Okay, these are 15-minute hourly candles. This is quite a big move that we're projecting from early on in the day. So what we could do here is, now that we have a point A again and a point B, is we could take the midpoint, 16,835. You want to make sure this is pretty perfect. 16,835.75 to 16,982 flat. So this gives us the 16,909 level. So what do we expect to see? Well, if this is actually going to happen, we should expect price to get above 16,909, come back down, accumulate on this in order to return back to point B and fulfill the constraints of the projected defined range, right? Point A is connected to point B. If we get over the midpoint and accumulate, we should fulfill the one below. So going further into the day here, let me get 35.75 back on here, 982 back on here. We press play. And right here, so a little bit later on in the day, price starts to toy with the idea of getting above 909. It so far has not gotten convincingly above, but now I would argue it has. So any movements back down into 909, so this little tap back down into 909, that to me, or this tap back down into 909, notice how it's coming back repeatedly. It's accumulating, right? It's creating the accumulation. This was the first stage of accumulation. This is the second stage of accumulation, right? Because point A to point B was onset right here, okay? And now we have this midpoint that's now accumulating again, which this is the setup that I enjoy the most, okay? This is one of my trading setups that I love playing, which is projected defined ranges, midpoint continuations, right? And this, any long positions in here should onset the move to trade up into 982. Another benefit of this is that you're entering the daily order block way before it's ever gained, okay? And as you notice, price runs directly where? Up to gain that order block. Now I want to show you something on a high time frame here. Notice that this is exactly where you would be entering, right? You would be entering on 909 in here. And what I want to show you is that, well, I can't see it here. What I wanted to show you is that price runs and never comes back down to that order block. So many times you'll see, well, price never came back down to this order block. How did people get long in here? They did get long in here, but you were just unaware that they got long before the order block ever even gained. And that is the absolute power of projected defined ranges. And that's why they're so critical to my trading, and why I can form so many amazing, huge directional swing trades based off of this projected defined range idea. Let's go and see a bearish example, and then we'll go ahead and wrap up the video. All right, as I was hunting for bearish examples, I went ahead and found this one as well, which is going to showcase the projected defined ranges again, but it's also going to showcase a time where that middle point second stage accumulation does not happen for a long time. So, but it's going to showcase how you could still use it for a bigger directional bias. So this is a weekly candle, right? So let's say this week is about to open and you have this here. Now we do not know if this is going to turn into an order block just yet. Okay, we don't know if price is going to trade beneath the low, but we know that this has potential to, right? If price were to roll over, then this would be a new order block in the range going lower. Okay, so how do we know if that's going to happen? How do we know if price is actually going to run down here and gain it? Well, projected defined ranges. Let's hop down into a lower time frame. Let's take it to a 4 hour, and the week opens now. So if price, in this case, is now below the weekly and it comes back up, tests. Let's go into the hourly. Look at what's happening. Price gets below the ungained. So this is where the weekly order block gains from the previous week. and price gets below the mean threshold here. You see, notice how it tries to actually hold it first. It tries to reject ever getting into the PDR or projected defined range kind of circuit of things. But then it actually gets below the mean threshold of the ungained order block. Okay, this is great because now it's holding it. So what does this create? This creates a point A to a point B. So from this holding here, intra-week, this could give you huge insights to where price is going to go. Price is going to go try to gain the weekly order block because it's holding the mean threshold of the ungained order block. And it needs to satisfy this point A to point B. It doesn't need to. Okay, I need to restate that. Market doesn't need to do anything. Okay, everything that's ever said on the internet about technical analysis is purely speculation and is purely probabilistic. There is no answers and there is no always. But for the most part, if you see the mean threshold of an ungained order block like this holding, this onsets the potential to tilt the probabilities in the favor to go to point B. As you can see, it goes right to point B, right? And if you were on a lower time frame and trying to trade inside of something like this, you could have found something like this inversion fair value gap, which you might not even know about, where price closed, traded back up into it. You could go short right there and take it all the way down into 558. Why? Because the projected defined range here is already set into motion. Let's go find, but notice how you don't get that midpoint reaccumulation. And sometimes that doesn't happen, sometimes it does. Personally, I like that setup, but the trade-off is that it doesn't always happen. So let's go find another bearish example here. Here is another example at and on Bitcoin. I came to crypto because I know a lot of people trade crypto, even though I wish they would all switch to futures because it's just a better market. I'm not talking about long-term trading crypto. Long-term trading crypto, you motherfuckers are getting rich. I have a friend who is up like 120 bands this month just because he has a long-term crypto long in Bitcoin. Anyways, this is not what this video is about. This video is about projected defined range. Okay, so boom. Okay, prices out all-time highs. We have a new week opening. Okay, we just swept liquidity above this high. If we don't know if this is going to become an order block or not, we have no idea. It's a mystery. But we do know that when this week opens, we have the mean threshold of this particular candle, and we have the low. So if we drop down to a 4 hour, okay, or maybe even a 1 hour if we can. When the week starts, notice how we push up into the mean threshold of the ungained weekly order block. If this starts to show a willingness to hold, which it does, right? We move away from it after going above it and distributing. What are we distributing off of? We're distributing off of things like this particular fair value gap above the mean threshold. You know, we have an interior liquidity sweep. We fall down on a lower time frame. You're going to see a projected defined range set up here inside of this hourly candle. Even notice how before this gains, we push up into the mean threshold of this hourly candle, right? So you're going to see that there also. But this is a weekly, a bigger example here. So we start to notice that price is above the mean threshold of the ungained weekly and it's distributing. What is this onset? This onsets a point A to point B to go gain the weekly order block, right? So we already know that the probabilities are on the side of price trading down to this level, right? At about this time, once you break this low, so probably at about this moment in time, you should already be anticipating price to trade all the way down to here and break this low, right? All these levels inside don't matter at all. They're not going to hold because there's a bigger projected defined range in play in the marketplace, okay? So anyways, so now you could have the midpoint of that, right? 559, and this doesn't need to be as perfect because it doesn't really matter. It should be perfect. When you're actually using these, it should be perfect. So notice we try to hold the midpoint for a moment, and then we get below it, and then we should see that second portion of distribution, right? And this is the portion that I personally like to play. You can play each side, right? You could play the high, right? You could play the distribution up here and get short up here, targeting down here. This to me has a little bit more confirmation. It looks a little bit lower in the range, but we know that the actual range is all the way down here. So this is actually just halfway through the range. So there is still lower price action to go, so it's not high up in the range at all, right? And price comes back up, and we start to see this distribution occurring on the midpoint. This is prime projected defined ranges, that this level is about a rocket price down to go gain the weekly order block beneath us. And what happens? Price rockets down to go gain the weekly order block beneath us. These shorts inside of here, with potentially like a stop loss up here, could be amazing setups. Or you could take the setup in here after the liquidity sweep. There's going to be an interior setup inside of here where you could have a stop loss above this, targeting all the way down. This is a little bit more risky in the sense you could go a little bit higher. This is a little bit more confirmation, but it's lower in the range. It's different setups for different personalities. But with that being said, you now know just about as much about projected defined ranges as I'm willing to talk about in this video. It's my concept. I came up with it. I never learned it from anybody. I don't know if anybody talks about it. I don't care. This is something that I figured out on my own. I started using on my own, and I'll be completely honest, I don't like talking about stuff that I figured out. Right? It's a bit weird for me because this is like my thing. This is what I did, and now I'm telling people about it. So if you want to learn more about it, again, join my Discord. This projected defined range idea goes much deeper than just order blocks. Join my Discord, join my stuff. With that being said, you know just about as much about order blocks as I do, and hopefully this helps your trading in some way, shape, or form. And if it did, drop a like on this video, comment down below what you want to see next, and subscribe to the YouTube channel. Hopefully you have a good trading week ahead, and hopefully you have a good day. With that being said, I will see you guys in the next video.
All right, let's talk about immediate rebalances. So immediate rebalances are not, in quotes, technically levels. However, they are events that happen on the chart, and I use them so frequently in my trading and for such a good amount of information gathering in my trading that I thought that I would include them in this course. So there's two immediate rebalances on the screen right now. Okay, there's a bearish one and a bullish one, and we're going to showcase them here, and then we're going to showcase examples on the chart. So all an immediate rebalance is a three candle pattern, just like a fair value gap. But instead of creating a fair value gap, that third candle, so instead of leaving a fair value gap here, which you should be familiar with at this point, that third candle trades up right to the low of the first candle in a bearish example, and you'll see a bullish example in a minute, and then it rejects off that. So for an immediate rebalance, you want to see a pretty perfect test, okay? And it doesn't matter how big this candle's body is, it's just that it's rejecting perfectly off the low of that first candle, okay? If it was like this, I wouldn't really class this as an immediate rebalance. Some people would, but I do not. When I am looking for immediate rebalances, I'm looking for very perfect tests. If you want to kind of understand this even better, you could say, if you want like a mechanical rule for this, you could say like below the, or at least within the range of the low to the 25% of that wick. And then that could count as an immediate rebalance. I personally don't use a mechanical rule for this. I kind of just eyeball it. And you get the feel for it. Trust me, you get the feel for it. Sometimes when people say that, you never actually get the feel for it. Trust me, you get the feel for identifying immediate rebalances. And all an immediate rebalance does, so once this candle closes, okay, this candle right here, once this candle closes, all that does is it signifies extreme aggression into the immediate next low. So if we use this immediate rebalance, and if we start to look left, look left, look left, look left, where's the next swing low? It exists right here, okay? So that's what that immediate rebalance job is to do. It's to get you into that low. And then right when you penetrate that low, this immediate rebalance's job is done, okay? So all a immediate rebalance is doing is showing and signaling a lot of aggression into the immediate next low. And then on a bullish example, of course, we have an immediate rebalance right here where we have, again, if this was to move like this, that would have been a fair value gap, and that's great. Cool. But it didn't, and we traded right to the high of the first candle's high. The third candle traded to the first candle's high. Once this candle closes, look to the left. Where's the next swing high? It's right here. So that's what that immediate rebalance job is to do. It's to signify and signal mass amounts of aggression into that high. Okay, so very simple theoretical part. Now let's go into the chart and show some examples, both bullish and bearish immediate rebalances. Alrighty, so let's start with some of the highest time frame recent history examples. of bullish immediate rebalances. So here's one, right? We had a immediate rebalance here where price traded right down into the top of that wick. Again, you could use the kind of rule that I told you, where if it's above that 25% level, in this case it pierces it a little bit. Again, it's not a, I'm telling you, you're going to get the hint of it, right? If there's no other high time frame level sitting right here and it's an immediate rebalance, then it's clear it's an immediate rebalance, especially because the second candle respects that as an immediate rebalance, because this candle is not an order block. This candle is the order block, right? This is not a fair value gap or an inversion fair value gap. It's an immediate rebalance. And what's the target of this? Well, it's quite simple. Just right to these highs, right? So if you were watching this on a lower time frame, for example, in this particular moment, you could be like, well, the monthly is immediate rebalancing around here. I could expect aggression up into this high. And since that's happening on a monthly chart, I mean, this could give you a lot of bias for quite some time. And then the same thing happens later, right? So price pushes up, and eventually we get this immediate rebalance again, right here. And inside this immediate rebalance, the next preceding high is just right here. So if you look on a daily chart, we came down, we immediately rebalanced in that level, and we ran right for that high. And that's how quick a lot of times it really is. It's just a very quick immediate rebalance and then a very aggressive push into the next high. Okay, that should make sense. That is two examples of bullish ones. I'm going to find some more examples of bullish ones, and then we'll flip over to bearish ones. Here we go. So we have an immediate rebalance that happens right here. And again, if this immediate rebalance is happening, we look, this is the candle that closes. We already took out that high. The next preceding high is right here. So after that immediate rebalance hits, we're expecting quite an aggressive run right up into here before this immediate rebalance gets invalidated. Again, immediate rebalances won't always work. However, if paired with other high time frame levels, which again we will show how to do by the end of this course, how to put everything together and have a full technical analysis system, they can become exceptionally accurate tools to showcase aggression. And then here's an example where we get an immediate rebalance at all-time highs. What do we do in this example? Well, we just be bullish, right? We be bullish. And if it's at all-time highs, there's nothing stopping us. So there is no highs to go target. Just be bullish. It's just a sign that the aggression is going to continue. You see another one happens here, but then it fails. And once that fails, you could start to maybe anticipate that maybe this high, if it gets ran, will be a liquidity sweep, or you're going to have a bigger pullback soon because immediate rebalances are starting to fail. Now, on a very high time frame, these are quite rare, okay? Especially in these markets. They happen every once in a while. Here's another one that actually ends up running. Here's another one right here. Again, you have an immediate rebalance, run aggressively to the next high, and there we go. And then here's a bearish immediate rebalance. Where's the next low? Right down here. Runs aggressively into that low. Let's continue going sideways and looking for immediate rebalances as we go. Here's another bearish immediate rebalance inside of this range. We push up, immediate rebalance, slams right into that low. Great. Keep on looking here. Keep on looking here. I'm doing this more real time right now just so that you guys know I'm not trying to cherry pick things here. We have an immediate rebalance right here, and then it slams lower. We have an immediate rebalance right here. This is an interesting example because we do get that immediate rebalance, and the immediate preceding next high is right here. So even though, and this is kind of a misconception that I get a lot, which is, oh, immediate rebalances are supposed to create extremely large moves. Not in any way, shape, or form. Immediate rebalances are just designed to go to the next high or the next low. And that's what they're meant for, right? Alrighty, let's keep looking here for immediate rebalances. Clean immediate rebalances at least. Here's one that didn't quite work, where you get an immediate rebalance right here in this down candle, and the very next low in this case would just be this low. And it just misses that low before it moves, right? A lot of times, if there's not a lot of range between the immediate rebalance and the preceding low that it should be targeting, that's going to be a lower probability immediate rebalance, which makes sense, right? Here we go. Another immediate rebalance here. This is the very next low. Where does price ends up reaching right into that low. Hopefully that makes sense. Here we go. Another immediate rebalance happening right here. Look left. Where's the next high? The next high is right here. Where does price reach up into? It reaches up into at least that high, which is very, very cool. Here's another immediate rebalance. Just to make sure I'm not missing any. I could be missing some, right? But I'm trying not to. We have an immediate rebalance. That runs right into the next low. Boom, right there. We have another immediate rebalance right here. Where should that run? Into the next high. Boom, right there. Runs into it. And yeah, this could go on and on and on and on and on. And a lot of times, these are going to be the things that break you out of a range-bound market or continue a very strongly trending market. So hopefully these examples of immediate rebalances help you start to learn how to identify them and how to potentially use them. So we have more technical analysis to learn, but if you've been enjoying the content so far, make sure to like this video, share it, join the Discord down in the description, and consider joining the Patreon. Without further ado, let's go into the next technical analysis things. Let's talk about new week or day opening gaps. So these are, again, just a fundamental part of how I do technical analysis week by week and day by day. So how I do these are a little bit different than what you'll see elsewhere on the internet. So when we talk about new week gaps, these specifically occur in the futures market and other markets who close over the weekend. So if you're looking at the cryptocurrency market, these will not occur. However, in the market that I trade, which is the futures market, these will occur almost every single week. And quite simply, all it is the closing price on Friday and the opening price on Sunday. If there is a difference in the price between the closing price on Friday and the opening price on Sunday, then we're going to treat that entire range from the closing price. So again, as you can see, this is the close. It's not this level because this is a down candle. This is the closing price. And then we have the opening price on Sunday. And we could take this range and extend this out for the entire week. Okay, so some people will tell you you could use these 6 weeks in the future. You could use these 100 weeks in the future. You could use these forever in the future. To keep it easy for myself, I just use it exclusively for the week that it exists. So Monday, Tuesday, Wednesday, Thursday, Friday. Next week, I will no longer be using this gap. I personally just use these during the week that they were created. And how do I use these? Well, when you're talking about new week gaps like this, it's quite simple. When price is below it, you're looking for it to act as resistance. And when price is above it, you're looking for these levels to act as support. You could step through them. You could utilize PDRs. Price is just going to treat these levels sensitive throughout the whole week in a perfect situation. Okay? And again, some people will tell you you could use new week opening gaps from 6 weeks ago, 10 weeks ago, as far as you want ago. I will do things a little bit different, and I also don't want to hear your opinions on this, okay? I've been trading this way for a very long time, and I've been doing it extremely successfully. So, respectfully, I don't care what your opinion is on this. I will only use it for the week that it exists. Here's an example. So this is the week prior, okay? And we have Friday's closing price, and then we have Sunday's opening price. Okay, this is the opening of the Sunday candle. This is the closing of the Friday candle. If there is any overlap in that, it doesn't matter. You're just looking for a gap of price. If it's like one tick of a gap, don't use the level. But if it's a fairly decent sized gap, if it's more than a couple of points, you could use this level and you could extend this out for the entire week to come. So what I mean by that is when I look at this, I'm only going to use this level until the next week, right? So this is Friday, Sunday, Monday, Tuesday, Wednesday, Thursday, Friday. So by the time that Friday's done, I'm going to, on the new week open, that's as far as I'm going to use this. I'm not going to extend this out further, and you will see sometimes, again, previous weeks will get used sometimes. But for me, for the sake of simplicity, I will only use these during the week that it's created. I'm just over saying this because I don't want people to be like, why aren't you using this? Why aren't you using that? I'm only using these during the week they're created. So that's from basically, if this is the one that gets created for this week, I'm only going to be using it during this week. And then once this week opens, I'm going to delete this one and I'm only going to be looking at the new one for the week. Okay? Hopefully that makes sense. Now, there's very, very rare exceptions for these new week opening gaps. And those exceptions come in the form of if there is no gap for a particular week and then the previous week's gap has not been traded into at all, then I will sometimes decide to use that as well. However, on a high time frame, especially when you're looking at a weekly chart, many times these present themselves as weekly volume imbalances or weekly overlap levels, especially ones that show up in the past. Okay, and I'm trying to look for an edge case example here that some people get caught up with. So I'm going to go find one more example of a new week opening gap here, and then we'll move on to new day opening gaps. Here we go. So this might confuse some people because some people might look at this where you have Friday's closing price and Sunday's opening price and be like, the actual gap is right here. When this is absolutely and utterly wrong, okay? Again, you're looking for the closing price of Friday and the opening price of Sunday. The opening price of the first candle traded to on Sunday, that is going to be your gap, and this is going to be the one that gets respected and utilized throughout the whole week. And again, if you're above it, you're looking for price to hold you up. If you're below it, you're looking for price to hold you down. If you're on the levels in between, same exact thing. And we could utilize this in tandem with something called PDRs or really any other high time frame level. So that's how I go about marking new week opening gaps. And again, just to hit this home, I'm not extending these forever, okay, like some people do. I'm extending these only throughout the week that it exists for. So in this particular case, you're going to have this gap until when? The opening time on Sunday. So you will have this gap for this amount of time. Okay, this is the entire week in which that, for me, this gap is relevant. Again, it does not mean that this will never get used again. Many times, and to be honest, often, price will come back and use old gaps. But to me, that introduces a lot of complexity in the way of just having a lot of different gaps and a lot of different levels on your screen that don't do a whole lot for you. So again, I sound like a broken record, and it's because I'm saying the same shit. But I'm only using the new day or the new week opening gap for the week that it exists in, okay? Now let's move on to new day opening gaps. Righty, so here we go. Again, we have our new week opening gap back here. All a new day opening gap is, for me, is it's just when the market closes for that hour, okay, here. The market closes at 12:55, or really it closes at 1, and it closes for an hour. This is pretty specific to the futures market. This is the closing price, right? And then this is the opening price right here. And it's exactly the same as a new week opening gap, except I'm only going to use this for the particular day, right? So this is 2 p.m. If you want to switch it over to New York time, you can. And you'll see this is the switch over between when the market closes. So this closes Wednesday's trading, and this opens up a new day of trading. I'm basically gonna use this until 6 p.m. The prior day. So if we look here, it keeps going. I'm personally going to use this new day opening gap until 6 p.m. the next day. I'm not going to extend it out or anything like this. And then basically, I just look to see if there's a new day opening gap. Okay, is there anything new on this particular day? 4:55 to 6. Is there a new day opening gap here? There is. It's very, very small. It's from this candle's close to this candle's open. It's very, very small. Can you use it? You can. Typically, I only want to use the bigger new day opening gaps, though, just visually bigger. And again, I'm going to let these go through the entire day that they exist. What you'll notice, however, especially if the new day opening gap is within the new week opening gap, you'll see that price oftentimes just tries to go for the new week opening gap levels. But what you'll also notice in the main importance of these levels, in my opinion, is not just to say when you're above them, they act as support, or when you're below them, they act as resistance. But to be honest, the more useful part about this is if, for example, let's say that, whoa, I just messed up my OBS. Sorry about that. Let's say that in this example right here, let's say that instead of, let's say that you have price action just like so, and instead of this, you never go down and you never fill in this gap at all. You just open and it goes right up. Actually, let me go find an example of this really quickly. Here we go. I found an example. So price closes on Friday and it opens up on Sunday, and then it just trades right down. Because this hasn't been traded through at all, oftentimes, very often, during the entire week, if this has not been traded fully through on the opposing side, this will act as a magnet to price action, kind of pulling it up and into the top end of this gap. So price typically, not always, let me make it very clear, not always, price typically tries its best to fill the gap. And then you can see right here we have a new day opening gap from the close of this candle to the opening price of this candle. You bring this along. Where am I specifically using this to? I'm personally just going to use this till 6, and then I look down and I say, do we have a new, or I don't use this till 6, I use this till 6 p.m. So this is 4:55 p.m., and then I'm going to be using this until Tuesday, 6 p.m. So I'm going to be using this all the way until here, okay? And at this point, we have a new day opening gap, which comes from the closure of this candle and the opening of this one. And this is going to be the new gap that I use going forward into the next day. So moral of the story, this is how I look at new week opening gaps and new day opening gaps. I only use new week opening gaps for the duration of the week that it's created, and I only use new day opening gaps for the duration of the day that it's created. So this is one of the foundational parts of technical analysis for me. Hopefully this helps somebody. Join the Discord down in the description. If you want to learn more, join my Patreon and enjoy the rest of this course. All right, now that we've gone through all the fundamental pieces of technical analysis that I use, let's take it up a notch and tell you how to put this all together to develop a very solid understanding of my borderline mechanical way of doing technical analysis. From this point on, you will no longer be learning new technical analysis concepts. You will be learning how I mark levels, how I prioritize levels, how I look at levels, and how I think about levels in total. So the very first thing that you have to understand is what time frames do I actually use? And this is very simple. I use time frames lower than the 1 minute, like a 15-second chart, for example. For very, very, very particular entries, I use a 1 minute chart for my entries. And then when it comes to actually marking my levels, I use a daily chart, a weekly chart, a monthly chart, and a yearly chart. There is also very niche situations, which we will go over, where I will also use a 4-hour chart, a 1-hour chart, a 15-minute chart, and a 5-minute chart. However, those are exceedingly rare situations, specifically when we are trading at all-time highs or if we are trading at all-time lows. But for the most part, and for 95% of everything I do, the levels that I mark are on a daily chart, a weekly chart, a monthly chart, and a yearly chart, and the actual execution time frame that I use is a 1 minute chart, meaning that I watch NASDAQ on a 1 minute chart, or I watch whatever asset that I'm trading on a 1 minute chart while utilizing levels from a high time frame. And for me, when I say high time frame, I mean daily or higher. And that's pretty much the actual time frames that I use. Now, you might be wondering, because I'm only marking levels on these very high time frames, there might be a total lack of levels, where there's just not many levels. What you will come to find, and what you will really come to find by the end of this course, is that is actually a lie. There is a abundance of levels in the market that exist on these time frames. On any given day, you might have 20, 40 high time frame levels in play for that particular day. What this does for me by only marking levels on a high time frame, though, is I believe that it gets rid of all the noise in the marketplace. It gets rid of all the unimportant levels. What you'll see a lot of times on the internet is a situation where people are pointing you towards 15-minute levels, 5-minute levels as places that intraday price action will make turning points at. And I highly disagree with this way of thinking. I am of the firm belief, and I think you will be of the firm belief by the end of this course, that almost every single turning point intraday, almost every single one, if it's going to make any sort of meaningful move in the market, okay, I'm not talking about these little interior things. I'm talking about major turning points in the market. Borderline every single one of those come off of a high time frame level, and it has absolutely nothing to do with your 15-minute fair value gap, your 1-minute order block, or anything of that nature. And if you think it does, you are wrong. Absolutely wrong. Now, if you don't quite believe me with those statements, please stick around and at least give it a chance. So, the way that I go about things is I start from the highest time frame down. And this is going to be my philosophy. Don't worry, we will do a lot of chart examples before this course is done. I start from the yearly chart. Now, the yearly chart is obviously the biggest time frame that I use. People can argue for the quarterly chart and higher time frames. For me, the yearly is the biggest time frame that I use. By the way, there's no particular reasons for these time frames that I use. I just think whichever time frames you are going to use, you need to have consistency with that, right? Only use those time frames. Sometimes I do not use a yearly chart. Okay. The yearly is really meant for very old assets that have a lot of data on them. Some assets just don't have enough yearly information for me to really care. And my process of marking high time frame levels goes as follows. Mark everything that is there on a yearly chart. Okay. And once that is done, go down to a monthly chart. Mark everything that is there on a monthly chart that does not overlap a yearly chart. Okay, so we'll learn a little bit more what that means in a minute, but let's imagine that you have, let me delete all of this. Let's imagine that you have a yearly level like this, and then you go down to a monthly, and the monthly level is right here, right? Instead of marking that monthly level, I'm simply going to get rid of it, and I'm going to prioritize the higher time frame over any lower time frame. So mark everything on a yearly that is there, go down to a monthly, but do not mark anything that overlaps a yearly. And then once you're done, you drop down into a weekly, mark everything that is there. However, it cannot overlap a monthly, and it cannot overlap a yearly. Basically what I'm saying is you go from highest time frame, and then you go down and you mark every single thing that exists on each of those time frames, and you just ensure that the things that you're marking do not overlap a higher time frame level in the chain. And what this is going to give you, in my personal opinion, is a very clear, very concise, very mechanical, and very good view on the important levels in the market that actually have relevance, right? If a daily level overlaps a weekly level, why would you give any credit to that daily level? You should give the credit to the weekly level because that has a higher time frame, which means it has more importance in the marketplace. Hopefully that makes sense, right? This is just the theoretical spot. We're going to do a lot of examples. And speaking of that, I think this is about it for the theoretical spot. The only exceptions to the rule are new day and new week opening gaps. If those overlap high time frame levels, that is okay. We will mark those anyways. The other slight exception is sometimes if you're marking yearly levels, you could have extremely large yearly levels. And in those particular situations, we will do things a little bit differently, which we will see in the examples. So the actual philosophy of how I do things is done. Let's get on to, let's do 5 full charting examples of how I do things. And yeah, hopefully this helps. Join the Discord down in the description, join the Patreon, and I'll see you in the examples. One thing that I just realized that I forgot to tell you is that on TradingView, which is going to be the platform you're charting on, by the way, hopefully everybody who's made it this far knows what TradingView is and knows how to use TradingView. You are going to want to use the continuous contract for any futures asset that you're charting. So what that means is it's going to have this little 1 on it. So if I change this to just show the ticker, you're going to see that every single one of these charts has this little 1 exclamation mark at the end. So some people will tell you not to do this, and they'll say use the actual contract month. And I'll tell you why this is a problem. So let's say you use the contract month. All your old high time frame data is really messed up. Like, look at this. You don't even have high time frame data back here. There's probably levels back here that you just can't see. So what the continuous contract does, if you just use the NQ1 exclamation chart, or let's say you're trading treasury bonds or gold, you use the exclamation point chart, this is going to stitch together all those contract months, and it's going to make it way cleaner. And then one thing that you're going to want to do is in the bottom right corner, make sure this B adjust is turned on. And the reason for this is as follows. With B adjust off, you have these large contract gaps, contract month gaps. So you see how B adjust is off right now, and this was the switch of a contract month, and you have this large gap right there. When you turn it back on, that's completely gone, and look how far this shifts. Let's mark this low, and let's turn B adjust off. That low is all the way down here with B adjust off. So for me, in the way that I trade, if you're trying to do things like me, turn B adjust on and make sure this set option is turned off. And then some other TradingView settings is just make sure this color bar is based on previous closed. Make sure that's not checked. Make sure it's unchecked. And you'll see, for example, up here, this candle was a down candle. So what this is going to affect on times is when there's gaps like this between candles, all it's going to affect is if it gapped down, it's going to turn this into a down candle. When in all reality, this candle is a up candle. So make sure this is checked off. Make sure set is turned off, and make sure B adjust is turned on. And once that is all sorted, you are ready to start marking your levels. So let's get into the 5 examples now. Everything's done. You've gotten to this point of the course. You've learned all the foundational parts of technical analysis. Let's get into the real part of this where I show you how to put it all together and how I go about marking my high time frame levels. Alrighty, so our first example here is just going to be on NASDAQ. And the reason is this is the asset that I trade every single day. So this is going to be the one that's most familiar to me. And, it's just going to be the easiest one for me to do. We're going to do 4 more other examples on other assets after this, though. And I'm really going to try to take this slow and explain every single high time frame level as good as I can to you while we're doing it. So, as I stated in the previous section, we are going to start from a yearly time frame. So the first thing that I want you to do is just look at what is next on the yearly chart. So we can see that we have this range of price right here. Okay, this has a down close candle in it. That means this is a order block. This is a yearly order block level. So we have the high, the open, and we also have the mean threshold at 15,651 here. So let's make sure this is right. And I'm going to show you the whole process here because it's very important that you do it exactly perfect, right? If it's 651.50, mark the level at 651.50. Don't do any of this bullshit where you're like hovering and it's like, oh, it's close enough to 651.50. No, these are exact levels and there is no room at all for interpretation. And then also, if we look at the top here, we've recently traded underneath this up close candle. That makes this up close candle a potential bearish order block. Okay. And by the way, I don't really believe in bearish or bullish levels. And we'll talk about that after this whole example section, just to give you some final thoughts. Okay. But as it stands, we have the opening price of this order block because it's now gained, right? We have the opening price of it. And then we also have the mean threshold level up at 113.75. Okay, and you could go in here and we could say 20,000, 13.75. That's going to give us the mean threshold level. And also, if we zoom in quite a bit here, what you're going to notice is that we have this volume imbalance level right here. Okay, Here we go. What's inside of a volume imbalance level? Well, we have the levels inside the volume imbalance level. So we have the halfway point, the 75% point, and the 25% point. It's not just fair value gaps that have these. It is any sort of gap having these, okay? Including new week gaps, including new day gaps, including everything. So if we look, there is nothing else on the yearly chart to mark, okay? You might be confused. There's fair value gaps way down here and things of that nature. I try to focus on what's kind of actually, I suppose, relevant to current price action. We got to understand we're on a yearly chart, right? So if we drop down and we look at a daily chart or even a 15-minute chart, these levels are quite far apart. So yeah, we have a lot of space in between. This is going to be the correct levels, and you could label them if you want. I'm at the point now. Holy stutter! I'm at the point now where I don't have to label these. I know some people like to be like, this is the yearly mean threshold, for example, and they like to mark their labels like this. I personally don't really care. So we're done with the yearly. Let's drop down to the monthly time frame now. And what is relevant here? Well, we have one thing, which is going to be this monthly fair value gap. Now, this is going to be a kind of an interesting case here. So generally, if we were going to mark this fair value gap, we would look to see if we could include the volume imbalances. Notice how the wick goes past the midpoint. That means we can never include the volume imbalances in this monthly fair value gap. So that means the actual only level that we have here is this. And notice how if we mark our monthly fair value gap like this, none of the higher time frame levels overlap that. And what I mean is, like, no yearly levels are going through the fair value gap. So that means we can use this monthly fair value gap as a level and be totally fine doing so. Okay? So that's one monthly level that we have. If we look more, this is going to be one of those niche cases with a yearly chart where if we look at this down close candle, this is a monthly order block. However, in theory, the yearly levels are overlapping this. However, in this particular case, the range between where the yearly is overlapping that order block and where we would actually mark, for example, the high and the opening price of that order block, that's an exceptionally large range. So I think it is totally acceptable in this particular case to mark the opening price of this monthly order block, the high of this monthly order block, and then also this particular volume imbalance right here, okay? And then same thing for this July candle, right? This was the wick that held up the range. We have since closed underneath that wick. If we were to mark the levels inside of this wick, what you'll notice is that the 25% level is right next to the yearly, but that's pretty much it. And I think this is where one of the very niche cases come in, where specifically with yearly levels, it doesn't really matter too much if the yearly overlaps a monthly level. And the reason that I give this particular exception is because if you do only allow things where the yearly happens, what you're going to end up having is like no other high time frame levels except yearlies, because yearlies kind of overlap everything. So with yearlies specifically, no other time frame except yearlies, I do allow that yearly level to be overlapping the lower time frame thing. Okay, hopefully that makes sense. And typically I make my monthlies 4 thick and my yearlies 4 thick as well. Alrighty, so I would argue we don't have anything else on the monthly here. You could go as far as to mark the halfway or the mean threshold of this order block, but I think that gets a little bit too close to that yearly. Same thing with the 25% of this monthly level. I think it gets a little bit too close to the yearly for comfort. And we don't really have anything else on this time frame that I would classify as a high time frame level. Let's drop down to a weekly chart. Alrighty, we got a lot of things here, okay? First and foremost, we are always going to mark the new week opening gap. Always. No matter what, we're going to be marking the new week opening gap, even if a higher time frame overlaps. Okay, so that's the first thing that we have. And this is a really easy way to mark it, right? This is the close, and this is the new week, right? You have your new week opening gap. And typically, I mark it following these kind of color guidelines. These are just specific to myself. This is just what I like. And I think that's kind of important. It's kind of something overlooked, but make sure you like the look of your charts, because you're going to be looking at this motherfucker a lot, okay? You're going to be looking at it a lot. Some people would look at the levels inside this weekly order block as it's an ungained order block. But look, we have monthly levels overlapping. We have monthly levels overlapping up here, so I'm not going to use the levels inside this weekly order block. However, you can use this weekly volume imbalance. Okay. And then if we look over here, we have 2 weekly fair value gaps. Now, technically, you could utilize both of these. Why would I not utilize both of these? When you have inversion fair value gaps like this, I'm going to prefer the one that held price more. If I get rid of the top one, this only held price up once. If I get rid of the bottom one, this held up price twice. So what I'm going to do is I'm going to use the top one. Okay, that's just a very simple rule for inversion fair value gaps, right? So that is the inversion fair value gap that I'm going to use. Now let's drop down to a daily chart. We don't really have anything on a daily chart. And this is what I mean. You have a abundance of high time frame levels here. We're not lacking high time frame levels in any regard. Okay, we do have this new day opening gap. Of course, I'm deciding to record this on a Saturday, so it's not like the market's open. So it's going to be a little bit hard to demonstrate the new day and new week opening gaps. However, this is what we have. And what you'll notice is that's it. We're done, right? You could go further with this if you wanted. You could drop down to a 4-hour and you could say, is there any 4-hour levels that I could use on this chart? I don't see any in particular. Maybe you could use this 4-hour volume imbalance because absolutely no other high time frame overlaps it. In this case, you would probably be looking at that 4-hour volume imbalance. However, generally, if we're not at all-time highs, I kind of stop with the daily levels. For me, that's just what I do. Okay. And what you'll notice is on a lower time frame, more often than not, price is just bouncing around these high time frame levels, right? You're going to be. And by the way, this looks like it didn't hit anything. It did. And it's called a projected defined range level, which unfortunately PDRs are such a large part of my actual edge that PDRs specifically I will not be introducing in this course. But as a hint to those of you who have more than 5 brain cells, look at a gap level like the monthly. Notice the 3 levels in between, okay? The levels here are from 501.25 to 403.75. This is the top level, this is the bottom level. Or this is point A, this is point B, or this is point A, this is point B. And the levels in between are just the halfway, the 75%, and the 25%. Look at these 2 yearly levels, okay? And just imagine if you would do the same exact thing between them and what kind of levels you would land on. These are 2 yearly levels. Imagine if you do the same exact thing between them and what kind of levels you would land on. Okay? I'm not going to talk much more about PDRs. However, I think I gave you a very good look at them. Imagine you have a gap. If you mark high time frame levels right, you have a gap between this monthly and this yearly. Imagine if you were to lay over the 75, the 50, and the 25% of the range of the gap. There you go. I'm not going to tell you more about PDRs. There's a little bit of information on PDRs in the order block section of this course. So if you want to take what I just said and then take the order block section of this course and put it together, by all means, put it together and use it. I am not going to explicitly state what PDR is about on this YouTube channel. That order block section of this course is going to be the best explanation you will ever get unless you join the Discord and the Patreon. But it's such a huge part of my edge that I'm not comfortable giving it out, at least in an easy way to the public. But if you want to figure it out, I've left enough clues for you to figure it out completely on your own. Okay? And what you'll notice is that price just plays around these high time frame levels all day long. And if you include PDRs, price is going to be around these high time frame levels 24/7. Every major turning point is going to be on a high time frame level. Even internally, price is going to play along these. Retesting them to go up, retesting them to go down, stalling at them. It's going to be stepping through high time frame levels. Notice it holds the monthly here. It holds that intersection. It holds it here. It holds it here. It steps down. It retests the yearly after trying to hold it. After losing it, there's a PDR level here. There's PDR levels everywhere, which again, you could reverse engineer if you want. But again, this is my mechanical approach to marking charts. It's just high time frame level down, what's there, and then which what results out of that is you have very, very potentially not that accurate in the sense of it's not going to test to the cent. A lot of times that actually will test to the cent. However, you get very, very important levels where very, very, very major moves occur from. And then if you time this with trading at the correct time of day, looking for the proper setups, not knife catching, and instead looking for re-entries, utilizing things like ATT, utilizing things like projected defined ranges, which are PDRs, which are my invention, my creation, you start to form and create naturally my trading system, which is the trading system that has allowed me to generate over $50 million trading in these markets. And when I say that, it sounds dramatic and it sounds like something that's impossible. I'm not joking. I've live traded every single second of my entire futures journey in my Discord, in my live trading call with over 70 people watching. I also trade forex. I have a stock account. I have long term. I've talked about how I'm investing my money. I do it right. I'm not just playing this game for fun. I'm not doing this for 10K a month. I'm doing this to make real money in a real way, in a consistent way that's highly likely, highly probable, and leads to a long career in the trading space. And doing levels like this is a big part of it because this makes high time frame level selection mechanical. It removes the thought process of marking levels. It's you're going to use these levels, and that's going to be the levels that you use. No questions asked. That's just what it's going to be. So let's get on to our next asset class in our next example. All right, so this is going to be the next example of a chart. Let's do that same process to the dollar index. Okay, so I'm looking at DX1 from ICE US. B adjust on, set off, start from the highest time frame. So the reason I wanted to pick dollar index here for our next example is because dollar index has a exceptional amount of yearly levels, and this can lead to complications. Right, so first and foremost, if we just look at where price came from, we had this big old yearly fair value gap up here. Price traded through it. We had this yearly overlap. Price traded into it inside of 1989. It came back up into it. Look where the bodies of this candle close. They close outside of the fair value gap. You could see how we reached right up into the halfway point and even the 25% level, and we've since moved on. Now we do have this ginormous yearly order block, and nobody can take this away, right? This is very clear, the yearly order block up here. However, I would go on and tell somebody not to mark this. Why? Because it's so far away from price. Let's look at price on a daily chart. This is eons away, to be completely honest. So I'm particularly looking for levels that are relatively close to the current price action. Now, what is relatively close to the current price action is this fair value gap, which is from here to here. And we have the levels inside of it. So if we mark out this particular fair value gap right here, okay, and then we mark out the levels inside of it right here, which we are going to have, typically if they're fair value gap levels, I personally like to make them solid and then one thick, like so. So there we go. There's the fair value gap with the levels inside. You'll see so far in 2025, we've ran up to the halfway point of that yearly fair value gap, and we've rejected off and started to sold off. Okay, on the yearly as well, we would have also had. By the way, I will not and am not using the levels inside of this wick. Why? Because this fair value gap is more important. Because this wick did not trade all the way through the fair value gap. If this wick had have traded all the way through the fair value gap, I would have been much more paying attention to the levels inside of this wick and paying a lot less attention to the levels inside of this fair value gap. Now you have another yearly fair value gap, which exists right here. And this is going to be the inversion fair value gap. And this is a lot of yearly levels, okay? This is indeed a lot of yearly levels. We also have the mean threshold of the ungained yearly order block at 103.630, okay? And I'm going to be completely real with you. Sometimes on forex pairs like this, I disregard the yearly in total. I'm going to leave that up to you whether you want to do it or not. However, I'm just going to tell you what I do sometimes. Sometimes I disregard the yearly in total because it's occasionally a lot of noise. But you'll also notice that price does trade in these levels, right? You're going to have price trading from here, holding off of here. This is a daily chart, right? Holding near the top of this. If you figured out PDRs in the PDR levels, okay? Up into here, it's holding off of this one. It rejects off this on the retest. It can't get above the high of here. It trades right down into the order block gaining. So it does indeed respect yearly levels, but sometimes it can be a little bit overpowering. And what I mean by that is it's just a huge amount. It's an absolutely astronomical amount of high time yearly levels. So what I'm going to do is I'm going to turn the opacity of these down to 10%, and we'll continue on with the level marking here. So if we turn the opacity down here to 10%, what do we do next? Well, we go down to a monthly. Is there anything here on a monthly? Now remember, specifically with yearly and monthly levels, I do allow overlapping. Just because if you don't, you're gonna have like no levels ever. So the very first thing that I personally see, and something that you might also see, is this fair value gap way back here. Now, why wouldn't this be the right fair value gap to use? Okay, why wouldn't it be? And you might be wondering, like, oh my gosh, this traded down into this level perfectly. What do you mean this isn't right? This is exactly what got tested. Well, look over here. We have to be mechanical with how we do with how we do technical analysis. This wick traded all the way through that fair value gap. So we remove this. The second that we traded over this wick, we need to start utilizing the levels inside of this candle as the actual levels here. And you'll notice that leads to a slightly less accurate expectation here. But if you're utilizing PDRs, which, fuck it, if you watch this long into the video, it's actually just as accurate, okay? But this is going to give you more accurate other levels, right? This is going to be the PDR level, or one of the 3 PDR levels inside of the range between these connected PDR levels, okay? So you could have connected and disconnected PDR levels. And it's actually going to be just as accurate as that inversion fair value gap, right? So these are going to be the monthly levels that we're going to use right off the rip. Now, on a monthly chart here, we also have the order block, which exists right here. But price is way down here. So I would be more willing to focus on price action close to down here. So we do have this monthly order block right here. I'm not super prone to use this simply because it's overlapping a older monthly level. So I don't particularly care too much about this monthly order block in April of 2023. What I care more about is going to be this fair value gap. So we had, let me see if there's a volume imbalance in there because it's going to be used if there is. We had a fair value gap from here to here that is now turning inversion, right? Can this turn inversion? That's my question. Yes or no? And we can use this level. Okay, so let's mark this up. Boom, boom. Let's make sure this is all good. Like these one thick. And there we go. On the monthly chart, at least for me, there's nothing else. There's actually nothing else here. You can mark the liquidity levels. You can say, well, here's the high, here's the low, here's the easiest equal lows, whatever. But as far as high time frame level picking, there's nothing else here on a monthly chart for us. By the way, I could be missing like an overlap or something, right? It's a little bit later for me. I know it's 6:56, but I'm an old man when it comes to this shit. You got to realize I wake up at 4 a.m. So let's drop down to the weekly chart here. And by the way, let's just for fun, what you'll see is the price action stepping through this monthly level as well. If you utilize PDRs, you could already see it. And price is going to use these levels, right? It's stepping through, rejected in this candle, rejected in this candle, rejected in this candle, holding off the bottom, falls right to the yearly. As you can see, these high time frame levels picking is doing work. It's doing a lot of work here. So let's drop down to the weekly. First and foremost, we're always going to use that weekly gap, which exists from here to here, which in this case doesn't really matter. I mean, we're so far down. But let's say that we were trading midweek. We would be using this weekly gap as well. I personally just like the way this looks here. Okay. I personally like the way this looks here. And that honestly is some of the only things that we would really be using. If you look, the reason we don't use this weekly wick is because we have a yearly level that would overlap that. So we can't use that weekly wick, but we can indeed use this weekly volume imbalance, which exists right here. And let's make that purple because I like my weekly levels purple. And drag this along. We can use that weekly volume imbalance. I would not use this weekly fair value gap because we have a monthly level overlapping, but we can use this weekly overlap that exists right here. Why? Because no high time frame level is overlapping it. So we can use this weekly overlap. And to be honest, that's close to all we could use. I don't particularly see anything else that we could use here on a weekly chart. Let's drop down to a daily. So again, we're always going to be using the daily gap level, right? That gets created right here. Always going to be using this level. So it pushes over. I like to make mine red, okay, with the levels inside being a too thick dotted darker red. That's just how I personally like to do it. There's nothing wrong with that. You could do yours however you want. There's no particularly right way to color them. This is just how I like doing it. Now you could have also used this daily inversion fair value gap, but because that's the same exact level as the new day opening gap, I'm going to prioritize the new day opening gap a little bit more. Okay, and in this particular case, you could also use the little overlap level right here on the daily chart. And I think, okay, I could be missing something. I think this is going to give us pretty much all the important levels for this particular asset. So you can see throughout the day, we're bouncing around these high time frame levels. If you're using PDRs, you already see what I'm seeing. Price is reaching and rejecting off this. It's coming into that daily level and rejecting. It's pushing back up above and rejecting. It's coming down into the yearlies. If you're using, it came right down into that weekly overlap level. It generated equal highs right below here, then swept up into it, and then it traded right into the yearly level up here. This whole way down, it's holding off monthlies. Notice how I'm not using any hourly levels. I'm not using any 15-minute levels. I'm not using any 1-minute levels. I'm relying solely on high time frame level picking. Let's move on to the next example. All right, let's move on to our next example, which is going to be gold. Now, I'm using gold because this is going to represent a very, very niche scenario where we're pushing and we are at all-time highs. So on a yearly chart, nothing. There's nothing here, right? All the yearly levels are way back here on gold. Right now, there is nothing here on gold. On a monthly chart, there's nothing. By the way, this little blue box, this is when I called the low of gold. I said this would be the low forever. And I was right. Okay, and I called that the day it happened. And you could ask anybody in the Discord. I'm not just lying. The one thing that we have on the monthly is a monthly immediate rebalance on gold. So this is just an indication of continued aggression, right? We're at all-time highs. It's not like we have previous highs to target or anything like that. We are at all-time highs and we're immediate rebalancing. This is letting us know that, hey, unless this immediate rebalance fails, right? It has 17 days where this could reject and fall all the way back down. Unless this immediate rebalance fails, it's probably still being highly aggressive to the upside. But besides that, there's nothing on a monthly chart. Let's go to a weekly. Is there anything on a weekly chart? No, there's not. There's nothing on a weekly chart. Is that unfortunate? Yeah, it is. It is unfortunate. Why is it unfortunate? Because there's just nothing here, right? There's just nothing here. Now, let's imagine that we started looking at this on the opening of this week. So we came in before this giant candle pushed up, because if we just looked at it now, it would be kind of boring. Let's say we came in before this giant candle pushed up, and we were looking at gold. What would have we had? Well, in the moment, we would have had the potential immediate rebalance level. And as a rule of thumb, because again, immediate rebalances to me are not in any way actual high time frame levels. They just represent an event in the marketplace. We don't consider that for the overlapping. Okay. The one thing that we do have is notice this wick here. This wick holds all the price action. So we have the levels inside of this wick as a level here. If you're using PDRs, you'll see that this actually does trade into this level to the cent. I'm going to stop talking about PDRs now because I don't really want a lot of people to figure them out. Okay. This also is the level of the order block. And for me, I wouldn't particularly mark this fair value gap because we have an older level right here that just overlaps it, right? Okay, so again, let's imagine we started watching price action on this week on the open of this. At the opening time of this particular week, we would have also had the levels inside of this weekly potential order block. Okay, we would have had the low here, we would have had the open, and we would have had the mean threshold of this weekly order block that was gained in the moment. Okay, and again, gain doesn't necessarily mean bearish. I don't believe in bullish and bearish levels. I think it's really stupid to have bullish and bearish levels. We'll talk about that more at the end of the examples. So we get rid of prices. Let me get rid of levels, for example, or I'm going to keep prices levels. It's fine. So we have those levels. Again, we're imagining we started looking at price at the open of here. One other thing is if we're not going to use that fair value gap, we can still use this volume imbalance on the weekly chart. And so let's do that. So then on a daily time frame, again, we're imagining we're starting to look at the price before this candle here. We would be looking at, first and foremost, the weekly gap, which gets created from Friday's close to Monday's open, which is right here. I don't know what the fuck is happening right now. Okay. We'd be looking at the weekly gap from here to here. This is totally good to look at. Right on. And we have the levels inside of that as well, which I'm going to make too thick, just like so. This is going to get a little bit repetitive, but I think it's important, right? And we don't have any other daily levels at all. Nothing. And there you go. That's all your levels, right? For when the market opened, that would be all your levels. So if we look at this, market opened, and look how it's treating these high time frame levels. This is why it's so important to have the right high time frame levels. The market opens here, and just look how it's treating these high time frame levels. I mean, we pushed out. Look at the bodies of the candles. They're all respecting. If you're using PDRs, they're respecting to the cent even. It comes up to here. It rejects off of here, right? It comes down. It falls to this high time frame level. Then it goes to this one, and then it's range bound between these two high time frame levels, right? And then it falls down into this high time frame levels. It rejects off the top. It rejects off this one. It falls below. It holds off this. It holds off this. It holds off this. Price is just bouncing around these high time frame levels all the time. If it's below the level, it's holding down. If it's above the level, it's getting held up off of it. It's holding above. It's holding above. If you're using PDRs, it's holding close to the cent, right? And there you go. That's how you do it. And you would evolve this throughout the week, right? If new daily levels came out throughout the week, if new daily gaps came out throughout the week, you would evolve those. You would add those in as the week goes on. But this is how you would have initially, on this particular week, marked your high time frame levels in this particular example. Let's move on to the next example. All right, let's look at Treasury bond futures. Nobody really trades bonds, but like whatever. Let's look at Treasury bond futures here. So the very first thing, again, we're on a yearly. Let's check if we could include it. Well, first off, let's check if there is a volume imbalance here. There is no volume imbalance. It's just the overlap. So the fair value gap here is going to be from this candle to here. That's going to be our fair value gap level. Right here is going to be our fair value gap level, right? And we could go ahead and throw in the levels inside that fair value gap. It's important to know, again, that the levels inside the fair value gap are not the fair value gap. The fair value gap is the entire box, okay? So if it just holds off the edge, it doesn't mean that it's not testing into the fair value gap, like what it did here, right? It just tested right on the edge. It doesn't mean that it's not testing into the fair value gap. And if it doesn't hit the midpoint, it doesn't mean that it's not testing into the fair value gap. It is. The entire box is the fair value gap, all right? So let's go back. Let's go back to the yearly here. And let's understand if there's anything on this chart that we could particularly use. So the first thing that you might be looking at is this monthly order block. And to be honest, you're probably right. I think you could use this. I was trying to find where this is rejecting off of, but that's not exactly what we're supposed to be doing. Okay, regardless of what it's doing, we need to be as mechanical as possible with the levels that we pick and choose. So 118.03 is going to be the halfway point. I'm just going to do this in a quicker fashion. Drop it here. And I think that we're pretty much done on a yearly chart here. Let's drop down to a monthly. Right. So on a monthly chart, we don't have a whole lot going on here. However, we do have a fair value gap that we're trying to turn inversion. So we could go ahead and mark that out. And to be honest, we don't have much of anything else. We have this giant wick, and we also have potentially the levels inside this bullish order block right here that we could use. Remember, on the yearly, I do tend to allow overlapping of a monthly level for all the reasons that I provided in, I believe, the first example. So we could use the levels inside of this monthly order block. That's totally fine. And to be honest, we could also maybe get away with using the levels inside this wick. The only thing that I don't know if I would do particularly here is use the 25% level, since it's so close to the order block mean threshold of the past. This is one of those very rare occasions where it's going to be a little bit of intuition. Do you want to use this level or do you not? Typically, if I have the choice between using a level or not, I'm going to not. That's, if you want a more mechanical rule, that's how I pick. If I have the choice between using one or not using one, I'm going to not use that. Okay. And then we have this overlap level that we ended up falling down through. If you watch on a lower time frame, you'll see that price is respecting these levels on the whole way down, because that's all price respects. It doesn't matter about the small little fucking tiny things. Now let's mark the levels inside of each one of these quickly. Okay. I'm doing all these examples in one sitting, so it's a little bit time consuming here. But that's okay. I want to put out good information into the world before I stop posting on the internet. So let's go to a weekly chart. We would mark this weekly gap here. This is so fucking huge that it doesn't really matter. However, this traded right to a PDR between the weekly gap and the yearly, which you're not going to see on a chart. And if you don't utilize PDRs, it's going to look like, well, you just missed that yearly, when in reality we held the PDR level. I'm giving you guys so many fucking hints about PDR. I need to stop talking. But whatever. I'm not gonna cut this shit out. So we had that. As far as other levels, we don't have much, to be honest. We wouldn't use this fair value gap for the reason being a high time frame level overlaps. We did have a lot of volume imbalances on the weekly. So here. And we also had it here. And then let's go into the daily chart. We had our new daily gap, which got created right here. Boom, boom. And that is, I believe, all we have. We wouldn't use this fair value gap for the reason being that a higher time frame level overlaps. We actually could use this daily fair value gap down here. And in this case, we could actually just use the inversion fair value gap right here. And this is totally fine to use. Notice how no higher time frame level overlaps this. It's sometimes rare that we get to use a daily level, but in this particular case, no higher time frame level overlaps. So there's actually nothing wrong at all with using this daily level right here. It's totally fine. And then we also have this daily volume imbalance that we could use as well. So drop that on the chart. And then cool. If you look down on a lower time frame, you'll notice, right, price is bouncing all around these particular high time frame levels, right? That's where it's stalling, that's where it's rejecting off of, that's where it's going to, that's where it's holding up off of, that's where it's going to. It just bounces back and forth until it gets down into this one. That's where it's going to on the way back up. That's where it stops. That's where it's going to. Price holds around these high time frame levels. And again, high time frame levels on their own are very, very useful, but you still need to frame a trade setup on the high time frame levels. You still need to have confluences like ATT on the high time frame levels, and you still have to execute on the high time frame levels, right? And I'm not a big fan of knife catching. So if you're coming right into the level, I'm not a big fan of just shorting or longing the next level that shows up. I want to see a setup happen on the level. I want to see confirmation happen on the level. I want to see more or less everything happen on the level. So yeah, that is our final example here. Right. So I just wanted to go through this final section here where I tell you a little bit about how I personally think about high time frame levels. So I don't really care what the hell the level is. I don't really believe in bullish or bearish levels either, especially if I'm executing on a 1 minute chart. If you're a trader that executes on a 4-hour chart, a daily chart, a weekly chart, skip this section. It's not meant for you. If you're trading on a 1 minute chart, these levels are such high time frame that the bullish and bearish nature of them kind of don't really matter at all. If price is holding here and we have any high time frame level above us and any high time frame levels below us, if we're below the level, I'm expecting it to hold price down. Okay? Or let me very quickly correct myself. If we're below the level, I'm initially expecting you to just push through, hold us up. However, if we hold off of this, I don't care if this is a bullish order block level. If intraday price is holding off of this, my expectation is down to the next high time frame level, because that's generally how price goes, right? It goes from high time frame level to high time frame level. And as we're coming down into this one, I don't care if this is a bearish high time frame level. If price holds this, I'm expecting it to go up to the next high time frame level. So I just treat high time frame levels as levels. I don't really give them bullish or bearish labels during the trading day. And I think if you're trading on a low time frame, giving them bullish or bearish labels is actually quite a toxic habit that you can have, to be honest. If I'm being completely honest, I think it's a toxic habit in general that you could have. So and all I'm doing is I'm trying to play level to level. At the high time frame levels, I'm not shorting off this immediately, and I'm not longing off this immediately, right? As we're coming down, I'm not longing when it hits this level, okay? Because I don't know if that level is going to hold or not, and I'm never going to make the assumption it is. I'm going to wait for a setup to happen on that level, go back and watch my 4 pillars setup, go back and watch my ATT, go back and watch the times a day that I trade. All the information is on this YouTube channel at this point. You just have to look for it. But yeah. In total, I have now gave you the full crash course of how I mark every type of level that I use, my absolutely mechanical technical analysis system, and I've given you ideas about PDR hints throughout the whole video. I've told you about ways that you can find setups, everything. At this point, you know just as much about technical analysis as I know. Now, good technical analysis, good level marking ability is not the whole picture. You also need to be good at reading price action at the high time frame level. If you want me to do another video about reading price action, let me know. I'm willing to do that. It'll be a long time before that comes out, to be honest, because it's going to be a long video to make, just like this is an exceptionally long video to produce. But yeah. If you want to know anything deeper about my trading system, if you want to know way more about PDRs, if you want to know more about reading price action, if you want to know more about anything really, join the Discord down in the description. There is a Patreon there. So if you want to learn more about my trading system that's not already on YouTube, it's going to be the Patreon. So it's behind a paywall. Some people ask me, why is it behind a paywall? It's because I'm protective about it. I made the system. It's my trading system. The actual technical analysis, it's not mine. Everybody uses fair value gaps. Everybody uses new day and new week opening gaps and stuff like that. But the way I trade is mine, and I'm very protective over things like projected defined ranges and ATT and things of that nature, and I want to be sure that it stays intact. I don't want a YouTube video to blow up, get 10 million views, and then this shit stops working, because that's going to lose me my income, okay? But I also do want to help some people. So it's going to be paid. The lowest tier is a very low paywall. And to be honest, I made it low because I know not many people are going to join. It's the same cost as a McDonald's cheeseburger. Okay? Right? It's not like I'm asking a lot from you. If you want to watch me live trade, there's also a tier on Patreon for that. But just with the lowest tier, you get access to every single video I've ever posted on Patreon. At this point, hundreds of hours worth. You do not need to join if you don't want to. However, I would still recommend joining the Discord at least, because if you join the Discord, even if you don't join the Patreon, I run giveaways all the time. With that being said, again, you don't need to join the Patreon. It's just something to consider. Everything you could want at this point is on the YouTube channel for free forever. And hopefully this video helps people. Rewatch it, watch it again. This is the exact technical analysis system that has made me over $50 million day trading. And I wanted to post it out there before I leave the internet for good, probably in 2026 or 2027. That being said, hopefully this helps you guys. I'll see you guys later.